On the back, at least most recent reports suggesting that inventories in the US are starting to shrinken, so that's giving a bit more of a lift to oil. There's the political risk as well, the geopolitical risk, as conversations continue around a potential ceasefire. But WTI, copper, iron ore also getting a lift in the session, so we look at the basic resources space as well, particularly here in the UK. We are 7 seconds away from the open, and of course on a day when maybe some investors will sit on the sidelines for more clarity on that data.
Okay, here we go. Volatility day. The volatility day begins. It's already begun. The bond market's already been open. But for equities, it begins. We are watching French assets very, very carefully. I suspect it may take, once again, a few moments for the French market to fully open. But in terms of some of the early indications on the downside and on the upside, and I'm going to talk about kind of weightings here, you are seeing SAP rising on the back of what we saw yesterday from Oracle. That's an interesting trade. ASML is the biggest points gainer. Some of the drug stocks are in the mix, but the oil stocks also are bouncing higher. To Anna's point, everything seemed to be lower yesterday from a sector point of view. Today, a little bit more green on the screen.
A little bit more green on the screen, and that oil story is interesting. The oil price is rising this morning, up 0.6% on Brent, 82.38. An industry report pointing to lower US stockpiles was part of the reason for that. We're waiting for the IEA's outlook. That report is due a little bit later on, and that can move markets as well.
On the French banking space then, currently Crédit Agricole getting a bit of a lift in terms of the early part of this session. So I
think I saw a Jefferies upgrade.
Close to 2%. There was a Jefferies upgrade. Maybe that was part of it as well. And to at what point does it look like a buy the dip scenario, given the sell-off that we've seen in French banks, if you have that confidence? So Crédit Agricole getting a bit of a lift. Siemens Energy up 1.7%, one of the gainers as well. Maersk, the shipping, of course, story remains pretty fascinating around the Red Sea, and freight rates 1.5% for Maersk. Lloyd's here in the London as well, getting a bit of lift, up 1.5%. On the downside, though, you're seeing some losses for the house builders here in the UK, and this is something I know is firmly in the wheelhouse of Anna Edwards, but Travis Perkins and Balfour Beatty taking a bit of a hit, down around 1.3, 1.4%.
Okay, waiting for an opening price on Rentokil as well. We talked about this with Joe Easton a little bit earlier on. He was taking us through this story. We've got an activist investor taking a stake of unknown size, but a top 10 shareholder now in this pest control business. I don't want to put anyone off their breakfast, which is always a risk when you talk about pest control at 8 in the morning UK. But certainly that is one stock that we will be watching to see how far it jumps. The ADRs were stronger. It has a substantial US business. So the thinking is this Nelson Peltz trying to persuade another business to go list in the United States?
As we see, by the way, in terms of that listing question, Raspberry Pi listing here in the UK getting a lift in terms of the... So we'll check on the trading for Raspberry Pi as well, because that stock gained close to 40%, and the CEO talking to me about the fact that actually, when it comes to the metrics in terms of the valuation story, he didn't see too much of a difference. He said he went to the US to check it out, New York Stock Exchange, ultimately decided, of course, on London. We zoom out to the macro, of course, given the inflation data out of the US, but arguably, potentially, more importantly, they're both significant. The adjustments around the FOMC and the forecast, the dot plots, of course. This was a question that the team put to Citadel Securities, Michael DePass, yesterday. Here's what we had to say.
I think for tomorrow, the focus really will be on the FOMC, and in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year, and the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
And of course, to be clear, there is an expectation that some members of the FOMC will not be making their decisions around the dot plots, the forecast, until after the inflation print, the CPI print. Let's bring in at this point then Norman Willeman, Group Chief Strategist at Union Bancaire Privée. Norman, good morning. Thanks for joining us. How resilient is this equity market to an adjustment lower in the dot plot?
Well, we think there's some probability the equity market will react to that. But I think, in all honesty, we're really just waiting to get into the next earnings season, which starts in July. And that's going to be the key driver as we move into the second half, because, as was pointed out, the market has already adjusted its expectation to a lower number of cuts as we go into the second half of the year.
That's interesting. So you're even looking forward. You're looking ahead. You're kind of looking past this to the earnings story. Is that on the assumption that if they cut on slowing inflation, that's obviously good news? If they don't cut, they hold, it's because the economy is holding up, and that's also good news for corporate earnings. Is that a view you would align with?
Well, if they cut, we think that will be a tailwind. But what we do know already is the economy in the U.S., and we're seeing the same in Europe, bottomed late last year. It's led by tech, but what we're looking for in the second half is that to broaden out into the non-tech sectors. And we think that's going to be the key for markets here. And so, a quarter basis point, half basis point, a quarter percent or half a percent cut in the second half. We don't think the difference of those two really makes a difference to what the earnings trajectory is in the back half of the year.
Norman, good morning. It's Guy. We have political volatility here in Europe. Does that make Europe less attractive as a destination for money at the moment? Do you think it makes the United States more attractive? Or do you think what is happening in November kind of balances the two out?
Yeah, the political volatility is interesting in Europe, but let's be honest. That's going to come in the back half in November in the U.S. as well. And we think the issue that was raised earlier, are we going to see a UK-style problem? We think that's an issue, but that's probably an issue for 2025 rather than 2024 from here. And so, again, yes, it's an issue. It'll bring some volatility. But that's going to be really pushed into next year when the governments, as they're formed, are going to be faced with very difficult fiscal choices.
So what do you do right now? What are you looking? It's amazing. You've got U.S. equity markets at close to record highs. We are waiting, as you say, for the next earnings season. We're trying to factor in what monetary policy is going to do. Just kind of talk to me about the symmetry of risk. How hard is it going to be to keep this equity rally going? How much further is there still to come on both sides of the Atlantic?
Yeah, look, we think there's another leg to this equity rally. As I mentioned earlier, you're going to see a broadening of that earnings recovery in the U.S., and that will spread to Europe. We're already starting to see that happen now. I mean, we think that's a narrative through year end. But alongside that, as you point out, you actually want to be symmetrical here, because as we get into year end, these risks are going to build, in particular in regards to this fiscal narrative that's playing out. And so we do want to start building some protection into portfolios. And so alongside that building of equity positions or maintaining of equity positions into this earnings rally, we're also starting to build positions in things like gold, inflation protected, to try and hedge against what we think is coming in 2025.
Norman, good morning. Do you have a particular view on UK stocks right now? We have an example this morning of a UK company possibly about to come under activist pressure to move its listing. We're not sure that's the strategy, but Nelson Peltz of Trian taking a stake in Rentokil, and he's previously taken stakes in businesses with big shares and bigger operations in the United States, and they have subsequently decided to go and list over there. Do you have any thoughts on UK capital markets at this point?
Yeah, look, we do think there's a lot of value in UK equities right now. And the good news is we're also seeing kind of, again, a cyclical bottoming taking place in both the domestic economy and obviously the global economy for the big names in the FTSE 100. So we think both are a tailwind to UK equities here. We've actually recently added to our positions in UK equities to capitalize on what we think is a cyclical recovery moving forward in the UK.
You make the point, you've made the point during this conversation about wanting to see the earnings season. That's where we started the conversation. And you think broadening of some of the things we're seeing in the tech space is key for you. Remind us, Norman, your view on valuations within the tech space because actually it's easy to lose track as these share prices move so quickly, but also expectations around profitability move quite quickly. It's easy to lose track. Where are you on valuations in tech?
Yeah, look, we think that's one of the key stories here. A lot of people are worried because we're up near all-time highs on a lot of these names. They haven't pulled back that much. But let's remember, underneath that, earnings growth has been tremendous. So if you look at some of the legacy big tech names, they're growing earnings 20-25% so far this year. And what that means is underlying valuations are improving, even if the stocks aren't going anywhere and staying sticky near their highs. And we think that's a good opportunity from here in some of the big tech names as we go into the second half of the year.
Norman, you've talked about increasing your exposure to UK stocks, UK equities, the cyclical story playing out. Looping back to the French story then, would you buy the dip? Have you been buying the dip on French stocks, French banks, other parts of that equity space?
Banks have actually done very well in Europe because of what we've seen on the interest rate side. You have a lot of banks really printing money given the movement that we've seen in rates from here. We are constructive in Europe, but to be honest, we've been a bit more cautious in terms of playing the recovery in Europe. We like the high-quality earnings streams that we see in Switzerland from here, and we think that should continue as we see some of this political volatility moving through the summer.
Norman, we're going to leave it there. Thank you very much indeed. Norman Villemin, Group Chief Strategist, joining us at Union Bancaire Privée. Thank you very much indeed. Let's take a little look at how the core six are performing this morning. You do have an SAP story that is developing. That's obviously a read across from what we're seeing on the Oracle numbers, which were really quite strong yesterday, and the move to the cloud certainly seems to be benefiting there. But a more mixed picture, I would say, across Europe this morning. I think it's interesting that luxury stocks in France are actually where the losses maybe are coming through this morning. Other areas are bouncing back, but you are seeing some weakness coming through into the luxury space. Let's get some more details as to what we're watching with single stocks. Joe Easton has all the details.
We've actually got plenty of red on the screen in terms of your results-driven movers today. A big profit warning out of Umicore over in Belgium. Now, this is a company that makes chemicals that are used in batteries for electric vehicles, and they are downgrading their guidance, seeing weakness in that market. Pretty interesting for the auto sector. Stabilus as well, down 15% in Germany. This is a company kind of operates in the background, making hydraulic springs that go into cars and other machinery, that kind of thing, getting hit on another warning, down 15%. And in the UK today, DFS Furniture, once again, another warning from them. They put out a lot of profit warnings over the past couple of years. I recently bought a sofa from them. They couldn't get it up the stairs, had to send it back. I don't think that's the reason, but the stock is down 9% today. Legal & General, this one, I'm scratching my head because they have actually announced they're increasing their share buyback plans for the next couple of years, but the stock is lower. Potentially investors wanted more out of that one. I'll have to dig deeper into the notes, but we're down 4% on Legal & General this morning. Then in terms of your cloud read across, we mentioned it in stocks to watch earlier, and we are seeing a little bit of a gain, as Guy mentioned earlier. SAP up 0.9%, Sage and Dassault Systems getting a bit of a move higher. Not much action over in Capgemini in France, given the focus on that election over in that market at the moment. Then in terms of your deals, Rentokil, a massive jump in this stock on news that Nelson Peltz has bought a stake. We don't know how much he's bought, but we do know that he is an activist that tends to try and influence strategy of companies. There is a question mark over the valuation on that one compared to the rivals like Rollins in the US's pest control. We don't talk about enough about pest control on the show, but Rentokil up 16% at the moment. Saipem ticking lower, down 1%, as Eni offloads a big chunk of the shares in that one. They are the largest holder with around 30% of the stock, but they're selling down some of that today, and we're seeing some weakness coming down given that was at a discount. We've got HSBC because they're also in the deals news. They're buying a bigger stake of their Chinese JV. It's a small deal for them, but that stock is in focus, so we keep an eye on that one. Then Raspberry Pi, it's the second day of trading. However, bear in mind, it doesn't start full trading until Friday. We're still in prelim trading. I was actually on a trading floor yesterday, and a couple of people were trying to buy it, and they weren't actually able to do the big size deals they want to. That will have to wait until the 14th. But it's another day of gains following a massive jump for that stock yesterday. We're up another 4%, the biggest UK IPO for some time. Finally, we've got one morning call in the banking space today. BBVA gets a downgrade. This is over at Exane at BNP Paribas. It's falling at 0.9%. Exane doesn't like the details of their attempts to buy Sabadell over in Spain at the moment, and that is the big thing for that stock at the moment. Exane recommends selling, and that one is coming down almost 1% over in Madrid this morning.
Joe Easton from my equity team. Speaking to the CEO of Raspberry Pi, you're saying there's an AI story there as well, which is interesting in terms of the demand. On your sofa, Joe, you've got the Lazy Boy. You've already got the Lazy Boy. You're going for the L shape, one of those big L shapes. So that's the problem. Did you try taking the legs off? Because otherwise I got an image of you reenacting that Friends scene, that famous Friends scene. Up a bit, down a bit. Pivot.
I was pivoting all the way up with the chaise long. The chaise long, that's the part I couldn't get around the corner. You know, I had to send it back.
There, Joe.
They sent me back a two-piece, so it worked out.
Challenge.
Okay.
All right, let's pivot from sofas to something else. Thanks, Joe. Equity team, of course, checking in on the movers today. And there's lots more coming up, team, on all things France. Checking in, of course, on the volatility. Checking on oats as well. Given the pretty dramatic moves we've seen in the sovereign debt of France over the last few days, there's a little bit of a recovery, as we've been noting, very, very modest. Currently, you're flat, unmoved on the 10-year at 3.22 in France.
So you did your own pivot there. Nice. From talking about Raspberry Pi and sofas into French
I'm learning from the
bond
best.
markets. So, yes, we're waiting for... This is day 3, isn't it, of intense OAT watch. Monday was volatile. Monday we saw yields higher, just, you know, unashamedly higher on political risk. Tuesday we saw them shoot higher and then come back down again, and today we're flat, waiting for the next leg of the story. I wonder, though, does it come from Macron? Because he can talk a lot, but if the worry is, from a market perspective, is that if the uncertainty is actually what others do, maybe we need to wait to hear from Le Pen and co.
What are they going to tell us? The lesson learned, certainly from the Labour Party here in the UK, is say as little as humanly possible in terms of the details around exactly what the policy is going to look like, ruling out a lot of things, not ruling in a lot of things. So clarity is maybe in short supply at the moment. French banks are still down. You look at Agricole, you look at some of these other banks, Monday, Tuesday, Wednesday, yes, they've gapped higher this morning, but they are still sharply down on the week, 4, 5, 6%. In terms of some of the losses that we're still seeing here. So we've not filled the gap yet in terms of the losses we've seen kind of from the beginning of Monday trade, out of Friday into Monday. And I think that's going to be, as Anna says, I think we need some more clarity before maybe...
Well, Norman Villemin was saying, look, he likes overall European banks. He wasn't being drawn on French banks in particular. He says part of that is the interest rate regime. Well, that's starting to adjust, obviously, at 3.75 now from the ECB. And then you combine that with the political risks around France. And does the appeal around French lenders start to fade? Or is this still a buying opportunity for companies that otherwise have been performing...
How many rate cuts are we going to see here in Europe? That is the other question as well. We still don't know. And if the Fed's hawkish today, how does that change the thinking surrounding what exactly the ECB can deliver here? I think also is another question. So there'll be a read across kind of which is going to augment the story that we're already seeing developing here in Europe as well.
Not the 13th Fed district, but certainly doesn't operate in a vacuum. So that seems to be the analysis that's often applied to that linkage across the Atlantic. I was noticing the auto and parts sector is considerably weaker than others this morning. I was about to put in a note to Craig Trudell asking what's happening there. But this has been a sector under pressure, of course, of late, but not entirely clear what today's driver is.
I can't remember if I saw a note first thing this morning. There is this idea that they are going to maybe pivot away from EVs and that we are going to see more ICE engines coming onto the market, more hybrid engines. But the sense seems to be that it's still not going to be enough to fill the gap, the problems that are being caused by the EV market.
We're waiting for the decision, of course, from the European Union as to whether or not they put tariffs in place. Part of it may be that Porsche Automobile Holdings ex-div today, so that's down 5.8% well. Because it's ex-div, so that may be a factor. One of your favourite car makers, Ferrari, is still posting very modest gains. But as you say, Anna, across the sector, down for the automakers.
Coming up on the programme, we'll get back to the French story as lawmakers from Macron's party openly question his decision to call the snap election. We'll discuss how the market is reacting to the possibility of a right-wing parliament. That conversation coming up next. This is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg. $8:20 here in London, 9:20 in Paris. This is Markets Today. We are 20 minutes into our European trading session, and you can see that the overall picture for European equity markets is broadly positive, up 0.4% on the stock 600. The CAC 40 up by around 0.25%, which isn't so far off the pace. I guess underperforms a little versus the DAX and the FTSE 100 today. So let's check in on French assets. We've got the equity market story. We've also got the bond market story developing for a third day here. We've got first for you the French bond yield story. And after we saw yields climb on Monday, volatile yesterday, the story today is fairly subdued. The 2-year, we do see a little edge higher in the yield there, but not by much. We're pretty flat on those yields as we wait to hear from the French president a little bit later on today. And in terms of the banking story, we're focused on what is a slight tick up in the French banking stocks, but by no means erasing the losses that we've seen over the last couple of days. So from an equity market perspective, we're not recouping those losses of 2 days. We're just pausing for thought, perhaps, and bouncing a little at the margin. Let's talk about what lies ahead. And the big set piece event is the French president. He's going to be speaking. Emmanuel Macron says his position won't be affected by the results of the snap election. His comments come after reports that he was considering resigning, which triggered a sell-off in French government bonds. Macron is set to hold a press conference at 10 a.m. UK time. That takes place in Paris, 11 a.m. local time. Let's get to Caroline Conan, who's joining us now from Paris once again. One of the big focuses for markets, and we've seen banks sell off as a result of this, real estate stocks under pressure, bond markets under pressure, yields higher, is that we don't know enough about what Jordan Bardella, who would become Prime Minister if the National Rally did well, if they got a majority in the National Assembly, we don't know enough about his policies and what that would do to the fiscal landscape. Talk us through the thinking there, Caroline.
And in fact, we just heard some concern also from the Bank of France governor, Villeroy-de-Galhau, who was saying whoever wins the majority quickly needs to clarify their fiscal position, their fiscal program. Of course, that would be in order to avoid a potential debt crisis, a potential least stress scenario for France after July 7. Now, who is Jordan Bardella? He's 28, very young. He's been groomed as the heir of Marine Le Pen. Actually, very popular on social media, 1.5 million followers on TikTok. But his economic program is very vague. We know from the 2022 presidential manifesto of Marine Le Pen a few parts of her economic program. I'll give you a few examples. For example, she wanted to lower the retirement age back to 62 or even 60 years old in some cases. That would cost at least 30 billion euros to public finances. She wanted to nationalize highways, which is why you've also seen some impact on some stocks like Vinci or Eiffage over the past couple of days. She wanted some tax incentives to hire younger workers and to increase salaries in some cases by as much as 10% for some employees, and also some zero-interest loans for first-time home buyers. So, of course, all this economic program has a cost. At the moment, the Institut Montaigne is saying this would cost at least 100 billion euros extra for public finances, and this is why the bond market in France is so stressed at the moment.
Talk to me about what's happening in the polls, Caroline. If you put the rally, the RN together with the Republicans, how big a force would that be? And what are the polls telling us about kind of whether that would be enough to form a government and kind of what the makeup of that government would look like? What are the polls telling us about what is happening on both the right and the left?
Yes, so you have to understand that the French legislative elections are a two-round system. So even if you see that the first round, Marine Le Pen's party would get 35%, that doesn't necessarily translate into the second round polls. So the situation here is really a case-by-case basis. There is going to be a lot of horse trading between now and the first round, and between the first round and the second round in terms of who is supporting who. We heard from Jordan Bardella last night saying that at least a few dozens of Republicans would actually choose to support a national far-right candidate and not put forward their candidacy in those constituencies. Now, the head of the Republicans, Eric Ciotti, even extended ahead to Marine Le Pen saying, we're going to support you, something the Republicans, of course, never done before. That was totally out of the question. There is a crisis meeting this morning at the Republican Party to know the way forward. We'll hear from the president as well in a couple of hours from now, and a lot is expected from him to clarify the situation, to see what kind of alliances he could seek in order to potentially get even a fragile majority like he currently has. At the moment, the National Rally has 90 seats in the National Assembly. They are shy of 200 seats to win a majority, but anything is possible if they do some horse trading with the Republicans.
Caroline, thank you very much indeed. There's a lot going on in Paris this morning. We're going to be watching very carefully throughout the morning. We'll certainly bring you the comments coming out of the Macron press conference a little bit later on. 11 a.m. French time is when that is going to be taking place. Coming up, we need to talk about what's happening in private markets. Blue Owl Capital CEO says private credit is still a good place to invest. Before mixed messages out of super return, we are going to hear from Apollo's head of EMEA Global Wealth Management Solutions next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is a really great time, and there have been some efforts by, I might call our antagonists, to paint the picture, you know, picking little anecdotes here and there, but the reality is that we have not seen an uptick in defaults. We have not seen an uptick in companies having trouble, you know, performing, and I think that's by virtue of making really good credit selections and low loan-to-value investments.
But others might say that, unlike the public market, you don't have a Fitch or a Moody's saying that this is a default on the debt the way that they would for something that's traded on the public markets.
Well, a default would be a default in any market. You're right. We don't have the opinion of the credit lending agencies on the business. I would proffer that's one of the great advantages of our model for the user of capital. Listen, at the end of the day, as opposed to a third party, and no offense to Fitch or Moody's, they do a wonderful, wonderful job for what they're designed to do. But we're designed to provide long-term capital and make a very in-depth decision around those companies, counting on the long-term strategy to get paid back, and it works. We've done about $100 billion in loans, and our running loss rate has been 7 basis points. And so there's something quite substantial about the ability, like a long-term investor in equity, to take a long-term view of the credit, not what happened this week or this quarter, but are we going to get paid back? And the terrific news about our business is we consistently get paid back.
Seems like an important point. Blue Owl Capital co-founder and co-CEO Mark Lipschultz joining us there, talking about what's happening with the private credit environment. Let's delve further into that world. Véronique Fournier, head of EMEA Global Wealth Management Solutions, joining us from Apollo here in London. Nice to see you.
Good morning.
Thanks for stopping by to see us. Look, today's going to be about a bunch of things, but one of the big things that it's going to be about is the Fed and this higher for longer world that we're increasingly trying to get our arms around and understand. You spend your time talking to wealth managers, to clients. How are they thinking about how they adapt to this higher for longer world where rates are going to stay higher for longer and potentially never really come back down to where we were sort of pre-pandemic? How far through that journey of understanding the implications of that do you think we are? And how far into the private world has that kind of story, seeped?
Yeah, I think the search for yield continues to be a major theme for our investors and our clients. And certainly as I spend time talking to wealth clients, the yield enhancement focus continues to be a big theme. Fundamentally, people are recognizing that private credit can be a very attractive place for them to shift out of their traditional fixed income into more private fixed income. I think they're seeing, the yields are inherently higher today. I think there's a recognition that you've got to be careful around who you're going to partner with. And so I think partnering with firms that have established track records, that focus on downside protection. So we're certainly seeing a lot of still continued interest for direct lending and private credit in general. Across the continent and then the Middle East.
So you've got to select your manager quite carefully. Is basically the message you're giving. There is huge amounts of uncertainty, though. We've got the Fed. You've got US politics coming up. You've got European politics that we're all trying to get our arms around, trying to understand what is happening in France right now. There is a huge amount of uncertainty. Yeah. Is that reflected in the conversations? And does that make your clients want to go towards or away from private credit? In a world of increasing uncertainty, is private credit a volatility dampener in portfolios? What role does it play, given the backdrop as well of higher rates?
Yeah, I think generally we're seeing that investors have felt the pain over the last couple of years of this changing environment that we're in, whether that's rates, but whether that's also geopolitics and just increased volatility. And I think investors have recognized that probably stepping away from some form of liquidity might enable them to access opportunities in private markets that can hopefully offer some more stability. And so generally, I think whether it's private credit or private equity or generally private assets, I think investors have recognized that stepping away, as I mentioned, from liquidity, stepping away from some of their public equity exposure to get more access to private market opportunities, diversifying their portfolio. The big theme is around diversification and recognizing, that a lot of opportunities sit in the private space. And why not, step away from liquidity?
Yeah, Veronique, you've said that a few times then, stepping away from liquidity, and that brings stability. Does that also increasingly, if that's the dynamic and we see it happen more and more in Europe, does that increasingly attract the eyes of regulators? Does regulatory scrutiny, if that's what they're doing, sort of stepping away from liquidity to find stability, does that attract the regulator?
I think actually the regulator in Europe has been quite supportive of the idea of private investors accessing opportunities that historically have only been available to institutional investors. And so I think we see the developments in Europe around structures like the LTIF. This is all about the regulator saying private clients should also have access to private capital. So, I think the scrutiny around liquidity certainly has to be there. The discipline, I think we have, been at the forefront of launching some of these more semi-liquid strategies and new structures and innovating in the space that requires discipline around, how you bring that liquidity. But I think actually the regulator is supportive.
And what's the lag between US adoption of something in this space and European adoption? Because you're growing in Europe, but it is, it is a place where maybe appetite for this kind of product has been a little behind the United States.
Yeah, I think it's been, I think we're super excited about the opportunity in Europe. When we look at when we did our analysis a couple of years ago, we actually estimate the market to be a 15 trillion market. So that's in terms of the wealth from EMEA clients. So we're super excited about the opportunity in Europe. But you're right, I think the lag comes more around the availability of structures. When you think about BDC, private BDCs, they've been around for 15 or so years in the US. In Europe, we've only had the LTIF launched maybe 5-6 years ago. And so it's just been a question of the structures and providing the access has really been more limiting in Europe, and there's been a massive shift within that. And so we now think that this is really a prime time in Europe.
Is it that those conversations with the potential clients in Europe, is that a key question for them, the relative illiquidity of some of these products and how you address that?
Yeah, I think many investors are now excited about the ability to come to private markets because these new structures allow them to do so.
And that continues to evolve.
And that continues to evolve. Historically, investors have had access to locked up structures with capital calls, and those have been operationally challenging for investors, whether they come through direct or whether they come through an intermediary. The fact that they're now able to trade on a monthly basis into a private markets fund has really kind of helped facilitate the access, and we see that as a big theme generally.
Give us a sense, give us some colour on the potential deal making for Apollo. There was that flagship deal with Intel in Ireland, $11 billion US. Apollo have talked about the fact that there are other deals in Europe that could be looked at. What is a good fit for Apollo within that space? Which sectors are looking most attractive? Where are you looking to put some of that dry powder to use?
I think it's all about being really a strategic partner to some of the large, sophisticated companies out there that are really looking to finance, their big strategic goals, whether that's around infrastructure, energy transition, the technology of tomorrow. So I think those would be kind of areas generally that we'll be looking to be a strategic partner to some of those corporate companies. Yeah.
Can you talk to me about regulation across Europe? We've been having a lot of conversations about the need for Europe to get its act together and form a more coherent picture for investors. We've got this patchwork across Europe in terms of the various regulators. Is that going to hold Europe back? Is that holding back Europe? You talked about the fact that we are 10, 15 years behind where the US is right now. Is that spread going to continue to grow between what is happening in the United States and what's happening here in Europe because we don't have a common approach to regulation?
I think that common approach to regulation is coming. I mentioned the LTIF already. Yeah. I think the recognition, I think the European regulators have recognized that they need that consistency in order to have the mass facilitation. So I think we're making progress in that direction. And I think there will be a world where we are, all using kind of the same structures across the EU. But we're starting from a base where maybe different regulators have taken a different view in terms of how illiquid assets should be getting into retail investors' portfolios. Yep. And some have taken a very open view to that in some countries, and some have taken a more restricted view. But I think there is a common acceptance now that that journey needs to be enhanced, and we think that the LTIF will be a big part of that.
Do you think regulators are going to wait till we've been through a full cycle? Private equity, private credit, private lending has been around for quite a long time, but it has gained significantly over the last few years in terms of the impact that it's having. Do you think we need to see? Do you think clients? Do you think regulators? Do you think the people you're talking to are waiting to see kind of the whole cycle emerge, an up cycle, a down cycle, before they get a true understanding of the opportunity that exists and the potential within portfolios that this space could have?
I mean, I don't see the investors sort of waiting and sitting by the sideline and kind of expecting that this market cycle, as you mentioned. What I do see is them being very excited about the opportunity to access asset classes that just hasn't been available to them. And that's been really at the foray only of institutional investors. And, I think that's, I see a huge continued demand. Yeah.
Veronique, nice to see you. Thanks for stopping by to see us here in London. Veronique Fournier, Head EMEA, Global Wealth Management Solutions, joining us from Apollo. Okay, what do we got coming up for you? A double whammy. Traders very much on edge at the moment. We are waiting for the US inflation data. We're waiting for that Fed decision. Anna says it's, 5.5 hours later? So we're going to pay attention to that gap, see what happens in the meantime. We're going to break it all down. We're going to talk about this next. This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big, American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent. and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right. That's
so
right.
whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
New Democracy did win the election with 28%, and that percentage is higher than the total tally of the second and the third party. So we still remain the dominant political force in Greece. So one should take into consideration the fact that these elections took place a year after a double national election, so there was significant electoral fatigue. We actually had a significantly lower turnout than the rest of the European Union at around 40%. But I'm sure there was also, some degree of discontent with issues such as the cost of living, which we need to address. We've been elected to implement an aggressive reform program for the remaining 3 years of our term. And this is what we should do. We now have 3 years without any other elections. And we will be judged again on our performance in 2027. But I think we sort of went against the trend where, incumbents in many other important European countries actually suffered heavy losses. We avoided that, and we're still the dominant political force in Greece.
Well, indeed, and we look to France, of course, for the reaction there. Marine Le Pen and the risks there, and the decision by the French president to call that surprise parliamentary vote, and of course the gains of the AfD in Germany as well. What do you make? What is your interpretation of the shift to some of those right-wing parties across the Eurozone, whether it's a protest vote or there is something more substantial going on here?
Well, first of all, if you look at the total numbers, the EPP, the main center-right European party, actually increased its numbers of Euro MPs. And the main sort of coalition between the EPP, the socialists and the liberals that has essentially governed Europe over the past decades remains the dominant coalition in the European Parliament. So I would argue that the European Centre held, maybe stronger than many people expected, and that this right-wing surge did actually take place in the two most important countries in Europe, but not across the entire continent. So I think there is maybe some degree of over-exaggeration about this right-wing shift of the European sort of continent as a whole. If you look at the numbers in the European Parliament, I think the important decisions will continue to be made by the three political families. And of course, nothing, I need to point out, nothing can happen without the EPP, which essentially has sort of a blocking minority now in the European Parliament. So I think all in all, the results were probably slightly better than many people expected, and I do think that there is a momentum to drive through important changes in Europe for the next 5 years.
That, of course, was the Greek Prime Minister speaking to me exclusively earlier today, saying don't overplay this risk, or at least the focus on the right-wing shift, reminding us that the EPP, of course, those centre-right groupings within the European Parliament remain dominant. He remains dominant. His party, New Democracy in Greece, which is within that centre-right grouping as well. There was a right-wing shift in Greece as well. Collectively, groups, a number of parties, there's about 3 parties that fall into that category, got about 18% of the vote. But look, Guy, as you were saying earlier, it's pretty fascinating to posit that Greece is now a beacon of stability within the Eurozone versus France and arguably Germany as well.
Germany is still, I think politically, Germany has obviously got a lot of questions that it still needs to answer. And this coalition is clearly very, very fragile. But you are seeing an effect of France into the periphery. And I think it'll be interesting to see how far that takes us. If you were to see a win for the right in France, how wide do OATs get versus bunds? How does that force BTPs wider? Does that start to cause maybe some dominoes to fall? I think that the market just doesn't know at the moment. Nobody really has got a handle on what is happening here. Yeah. The politics are a bit of a shock, and the markets, I think, are kind of in uncertainty mode.
And you were asking our guest from Natixis earlier that very question about, how wide does the spread get if we do see a change in Parliament? And the view from Natixis was that we're not talking about a base case where you've got to price in Frexit. That's not what we're talking about here. But we are talking about real uncertainty on the fiscal front, and that really seems to be the question that the markets want clarity over. And what's interesting is we're going to hear from Emmanuel Macron, the president, later on. It's not up to him to give that clarity right now, because, of course, if he says he's staying in power, that's one thing. But if the makeup of the Parliament changes, then we'll want to hear from the National Rally. We'll want to hear from them what their plans would be if they put the Prime Minister in place.
Yeah, and you've underscored that there's the importance of listening to what they detail on their plans. And Caroline was outlining this is not a traditional right-wing party in terms of its fiscal priorities. This is a populist party, so nationalising the roads, for example, reducing the retirement age to 60 with the huge hit to the finances that would. Are they sticking to those kind of pledges, or will they moderate, if you suggested, would they caviar
Who would the finance
to the kind of
minister
Maloney type?
Who would the finance minister be?
Yeah, it's okay. You've got a 28-year-old prime minister.
Yeah, precisely. We're only there are articles that are being well read on the Bloomberg and elsewhere about who this guy is. Yeah, we're trying to get our arms around who Bordella is. Who would be the finance minister? My understanding is, and we talked to a lot of French CEOs, nobody knows yet. Everybody's trying to answer that question. Who would be the finance minister of this new government? What type of finance minister would they be looking for? What are the kind of expectations of that? Nobody knows.
Yeah, these will be the key questions then. Let's get a markets perspective from the Markets Live team. Bloomberg strategist Ben Ram joins us. Ben, help us understand what it is that the market is going to be watching for, because we will hear from Emmanuel Macron, the French president, today. But really, the market is very keen to hear from the National Rally and what their plans would be if they were to be successful in July.
Absolutely, Anna. If the National Rally were to be successful in July and they're going to follow populist policies, that is going to imperil France's fiscal deficit. It's already at 5% of GDP. That reads more like an emerging market fiscal deficit rather than a budget deficit of an economy as advanced as France's. So if it worsens the fiscal deficit, I think that the markets will be right in their fears, and which is why we have seen the French yields spiral. And I think that continued pressure is going to be present on French securities. I think that in traders, as far as the traders are concerned, they're going to be selling the securities first and asking questions later. As you were just talking on the show, there are plenty of questions about who the next finance minister will be, whatever the implications. So the traders are not going to wait around to see the implications. They're going to first hit the sell button before talking.
Okay. Ben, what does this mean for BTPs? What does it mean for Spanish bonds? What does it mean for Portuguese bonds? What does it mean for what we used to describe as peripheral Europe?
Absolutely. I mean, it's a bit of an irony that the rest of peripheral Europe is doing better than, the core economies. As I wrote this morning, if it rains in Champs-Élysées, it's likely that the umbrellas will go up elsewhere in the region as well. And that's the collateral damage that we are seeing at the moment, because investors are thinking, well, if this is what populism means in Europe, what does it mean for Italy? What does it mean for Greece? At the moment, it's contained, but there will be some repercussions, meaning that yields will widen. Yield spreads will widen that much more in Italy and Greece, albeit not to the extent that you would see in a typical distress, but a bit of widening is par for the course from here.
Okay, Ben Ram. Look, we don't have any certainty on the political front out of Europe. Thank goodness we have certainty when it comes to the Fed. Question mark. Ven actually saying from MLive, thank you, Ven, that there's a view that he thinks the Fed should actually, in terms of the dot plot, should go to zero for this year. That's Fed.
The markets are one.
Yeah. So
in order to be hawkish, do you have to go to zero?
Is that what's needed from this Fed to convince the markets? Is
policy restrictive at the moment? Does it feel restrictive? Now you're seeing a very gradual slowdown in terms of the data, and there is this concern that you see a re-acceleration. In order to be how do you communicate restrictiveness and the fact that we are going to maintain our restrictiveness? Is it you just take it to zero? And that would be beyond where the market currently is priced. That
would have been an incredible hill that we've walked up and down again, wouldn't it? Over the course of 2024, if that were to be the case. You know, we're kind of in the middle of the year, and we got so overexcited in December at the prospect of rate cuts. 7, exactly. That kind of festive gift that we got from Jerome Powell. And we've spent all the year so far, year to date, it's just been an exercise in working that back, walking that back. And yeah, where does the Fed leave us then at this June check-in on the dots?
And yet equity markets have continued to rally.
Yeah, well, that was the point that we heard from Norman earlier. You asked, well, how vulnerable are stocks to if we get the Fed saying we'll only get 1 cut, maybe 2 cuts, or even 0 cuts this year? How vulnerable? He didn't seem too moved. He went very quickly to a conversation about earnings. He said it's all really about the earnings story. That's what we're waiting for.
Yeah, I wonder if these tariffs from Europe on EVs is going to affect the earnings stories for German and French automakers. This is a story that lines cross, and we haven't had it confirmed yet.
Yeah.
But in terms, we've been waiting for these tariffs to be announced from the European Union, and EU is to notify China on EV tariffs today. That's according to officials. Tariffs may be around 25%, not confirmed yet, but maybe around 25%, not insubstantial or unsubstantial. Then China earlier saying that EV tariffs would undermine Europe's own interests.
Okay, let's just talk about that for a moment.
Yeah.
So, in some ways, you could argue this is good for European car makers because they will be protected from Chinese EVs, but you could also argue it is absolutely shockingly bad because the big luxury brands in particular rely heavily on China in terms of their profitability. Now, that's been under pressure recently as the local brands have come through so strongly, but this is the double-edged sword.
Yes, and markets seem confused about all of that because even before we got this news around where the tariff was going to be, I mean, maybe the market had made assumptions about what it would be already because we knew it was coming this week. Even before we got that news, the sector was selling off this morning. It was underperforming. It kind of bounced back a little bit ahead of the news flow. Now it's selling off a little this morning. There does seem to be a lackluster appetite for autos this morning.
Olaf Scholz has been pretty firmly against this over in Germany. I bring it back to the French politics. If you had to have a Marine Le Pen or her party in power, to what extent would they double down on this kind of push for further tariffs?
Well, if you take the Trump playbook, he was aggressively against China, aggressively for tariffs. That was the narrative that came from there. Is that something that will be replicated here in Europe on a more assertive basis?
And how much does, if we did see a far-right party having more control, exerting more control in France, how much does that question lots of things we've assumed about the EU going on from here? And that's what this year is about, really, isn't it? It's about loads of people going to the ballot box and getting another assessment of support for some of these European policies or not.
3 big volatility events today. Let's talk about them. You've got the Emmanuel Macron press conference. That's going to be taking place at 11 o'clock. Look forward to that one a little bit later on. Then we're going to get into Fed territory. Get CPI first, 8:30 Eastern. 2 o'clock is the Fed decision. The surveillance team is going to be bringing you special coverage of that Fed rate decision a little later on today. It's all going to kind of kick off at around 6:30 p.m. London time. I will be up. I will be tuning in. You should be as well. It's obviously late in the day when you start this early, but we've got a stellar cast coming up to join the team for all that data and the Fed decision. Former St. Louis Fed President Jim Bullard's going to be joining us. Mohammed, of course, is going to be on the team as well. Mohammed Al-Arian is going to be giving his view. Bank of America's head of U.S. economics, Michael Gapin, is going to be joining Bloomberg as well. We've got an exclusive conversation coming up a little bit later on as well with the legendary short seller, Jim Chanos. That is a conversation you are going to want to tune into. It's a big day. It's going to be a volatile day. There's some major events that you're going to want to watch out for. Bloomberg has got it all covered. We're going to continue the conversation next. Francie Lacroix is going to be picking up the baton. The Pulse is next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. And market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. U.S. stocks powered to another record, but a rally in treasuries takes a pause as traders await a double whammy of U.S. inflation and a Fed decision. The French President Emmanuel Macron is set to address the public in the next hour after his shock decision to dissolve Parliament rattled the markets. Plus, the EU is actually set to notify Beijing today of tariffs on Chinese EV makers, while companies could face additional levies of around 25%. So good morning, everyone. We have this double whammy, not only CPI, but also the Fed. So it's going to be a busy, busy market day. Now, the picture overall is one of calm, certainly of relative calm to what we saw in the last couple of days. The market's really being taken by surprise, more by the dissolution of Parliament of the French president than the rise of the far right, certainly when it comes to European elections. Now, the CAC 40 gaining some 0.5%. You see the FTSE gaining 0.7%. We saw quite a lot of volatility, I would say Monday and Tuesday, of course, in European assets, and that appears to be subsiding overall. Investors were caught unprepared. I know there's a lot of possible scenarios about what happens to politics in France, and then the calm, I keep on being told by people on the trading floor, could be short-lived because of this double whammy of U.S. CPI data and the Fed rate forecast potentially upending markets. There's no better day to speak to Grace Peters from JP Morgan, so that's coming up shortly. S&P futures, you can see practically unchanged, a little bit more calm, certainly, than we were yesterday at the same time. The France 2-year 3.185, then the U.S. 10-year 4.4001. Then we're getting some breaking news out of the IEA saying that a major oil surplus has been seen, or they see it this decade, as demand has been peaking. Now, remember, there have been a number of analyses on that front for the last couple of decades. So it's unclear to me and to a lot of market participants when we reach peak oil, but something to keep in mind. And you can see Brent crude and, of course, WTI getting some between 0.7 and 0.9%. So to talk about the Fed, to talk about CPI, let's get straight to Grace Peters, the global head of investment strategy at JP Morgan Private Bank. Grace, what a big day. I mean, if there's any market-moving day, today is probably the one. Are we going to see, a lot of volatility on the back of CPI?
Yes, hello, so nice to be here. As you say, what a day and what a week. We've just released our mid-year outlook called A Strong Economy in a Fragile World, and I think that actually perfectly epitomizes many of the dynamics we're seeing at play. In terms of CPI today and sort of your question around volatility, I mean, inflation is still absolutely one of the key metrics that we're looking to. And when we think to expectations for the Fed, I think it'll be, yes, obviously influenced by today's CPI print, but also we're expecting a new SEP from the Fed, new forecasts, and a new dot plot. So I think there is going to be a lot to analyse. From my perspective, what I'm looking for when it comes to the FOMC and their reaction to most recent data, I think when we're not expecting any change to the near-term policy rate, but I think there will absolutely be a focus on where they think core PCE is headed. We think, if anything, they're going to increase their forecast to around 2.8% for the fourth quarter of this year. And obviously, on the dot plot, to me, there's two things. Firstly, how does that evolve? We know that it was 3 cuts this year they had priced, expected previously, just by a slim margin. So will it be 1? Will it be 2? If it's 2, I think you could actually see quite a positive market reaction. We've started to see, or we've continued to see, so to speak, new highs being made in the S&P, and I think that will further support that. That's certainly in line with our view. And then the other thing I'd look for from the FOMC is really that longer-term dot plot, their estimate of the neutral rate, which again has nudged up in recent forecast changes, and I think that will be the continued direction of travel.
So Grace, as you say, today's also a big day because it's your mid-year outlook 2024, and a lot of market participants kind of wait for this to try and understand what the next 6 months, and it feels like it's just going to be a lot more volatile because of politics. But you're expecting a strong economy in a fragile world. I think that's the title of it. Does it mean that it could shift quite quickly?
No, so the outlook really is intended to recognise that we do think that there is economic strength, trend growth rates supported by strong corporates and strong household balance sheets as well. But the world has many fragilities, and that makes investing feel uncomfortable. And so a lot of the work that we're doing with clients at the moment is to say, look, our investment advice is to be fully invested. But the conversations around making sure your portfolio is resilient, given those fragilities, is incredibly important. And so we do think that equities are going to be the growth driver. As part of our forecast changes, our price target for the S&P for mid-2025 is 5,700. So we've got a very healthy level of upside to the S&P over the next 12 months, and other European equities markets, including Europe as well. But, there are other assets that we should think about as well to reflect the tail risks. So that include recession and higher inflation, and a lot of that, fixed income for recession, but alternative assets for us is a large focus as well.
And in your mid-year outlook, you also pick basically 2 main themes, which kind of goes to the heart of really everything that we're living day to day in our daily lives, but also in the markets, which is AI and security. So how do you play those thematically?
Yes, absolutely. So these are the 2 multi-year themes that will affect the next 12 months, but also the longer-term time horizon. When we're thinking about artificial intelligence, whilst it's been something that's been so discussed over the last 6 months or so, we think we're just getting started. And when we think about the percentage of companies using AI today, it's about 5%. And when we think about, the companies in their most recent earnings report who's talking about using AI, that's 50%. So we think we're just at that inflection point. How do you play it? Well, it's through the value chain. Yes, it's large mega cap tech, but it's also thinking through data centers. It's thinking through the power needs. If we think about the new data centers, the AI data centers, they're likely to need 5 to 10 times the amount of power versus a traditional data center, and that obviously has implications for power generation, power transmission, power storage. So we think there's actually quite a large value chain to play, and then there's obviously every sector is going to be impacted by this. And so it brings us back to focusing on quality companies that have the balance sheets to make the investments, to get that first mover advantage, and obviously still distribute to shareholders at the same time.
So expensive companies.
Well, to some extent expensive, and I think this is part of where in our outlook perhaps we're more contrarian, because we actually are quite comfortable with company valuations in the large cap space when we're talking about these firm balance sheets, because when you look at corporate margins in the US, at the highs, and in Europe recovering very nicely, some may say that that's a fragility in itself. We think that's indicative of the way companies have done a fantastic job at actually being very efficient at converting, the equity into cash flow for shareholders. So we feel more comfortable around large cap equity multiples, but we are avoiding unprofitable companies, over-leveraged companies, and so there is that split when we think about risk assets as to the ones we want to own and the ones we don't.
And Grace, again, security is another big theme.
Yes.
That kind of encompasses geopolitics. It really has everything. But what's the right way for investors to play on that?
Yes, and I mean, geopolitics, when we speak to our clients, and I think when investors are surveyed across the market, this is the number one risk. And again, just to reiterate what I mentioned before, we think that shouldn't prevent you from being invested. Yeah. But I think that whilst history would say geopolitical events have a limited impact on markets, markets, what I feel is that the definition of national security is undoubtedly changing, and that has implications for the way governments think as well as corporates. So supply chain security, energy security, and cyber security, linking back to AI, really important. When we think about investment opportunities, they're global and they're in sectors like industrials, infrastructure assets, and also some materials.
And Grace, no matter are these two themes here longer term? So really, no matter what happens with CPI or Fed today, or even some of the volatility, this is basically a long-term.
These are long-term themes that absolutely form part of shaping portfolios today, but also that portfolio resilience as we think about building wealth over time.
Grace, thank you so much for joining us today. Of course, talk about Fed, we have CPI, and then the mid-year outlook for 2024 by Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Now, a couple of things that we need to show you. Of course, on the corporate side, Oracle reported better than expected bookings and announced partnership deals with tech rivals. The software maker focused on expanding its cloud infrastructure unit, which runs computing power and storage to compete with Amazon, Microsoft, and Google. Oracle, look at that, pre-market gaining 9%. Now, coming up, what higher for longer means for leveraged finance and private equity. We'll discuss this with Hobie Bruvat, co-head of capital markets EMEA at Deutsche Bank. That's coming up next, and this is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back, everyone. Now, investors pouring cash into leveraged loans, making the risky asset class a star performer in credit markets. Now, it comes as a prospect of higher for longer monetary policy boosts the appeal of debt with a floating rate. While U.S. leveraged loans have become some of the biggest winners in this global fixed income this year, netting 4% for investors, topping the charts along with Asia-Pacific credit. That's according to data compiled by Bloomberg. Well, I'm delighted. I actually could not be more delighted to speak about all of this with Hobie Bruvat, co-head of capital markets EMEA at Deutsche Bank, as a German lender holds its European Leveraged Finance Conference here in London. Hobie, thank you so much for joining. I mean, there's so much going on, and actually, I just want to know whether you're confident about the months and kind of quarters ahead. Is activity coming back? Is there pickup? Do you feel good about it?
Yes, thank you, Francine, and thank you for having me. Yes, we do feel good about the activity levels. I think, when you look at volumes in particular in European leveraged markets, year to date, we've already exceeded, all of 2023 volumes in leveraged loans, and high yield is also, doing the same in terms of, issuance volumes. Most of the issuance volumes have been for refinancings. So, I think what we are waiting for, is a bit of activity on the M&A side, so on the buyer side. But I would say so far, very good technicals. The investors are very keen to invest in those new issuances. And, there's really no reason to think that the technicals will change materially in the months ahead.
But so when you look at the market, it seems that there's a leveraged loan resurgence issuance in the U.S. this year. And actually market activity in Europe is a little bit slower. And I don't know whether you can pinpoint to the reasons or whether it's just a late laggard.
Yes. No, I mean, look, I think it's basically, first the stock of deals that we have. In the US, they've actually already had, some large transactions also on the buyout front, which we have not really seen in Europe. So when you look at the, primary issuance and the use of proceeds, again, away from refinancing and corporates, sort of addressing the maturities, that they have to address, we do need some more buyout volumes. And in the US, being a larger market, we've seen more of them, and we've seen more larger transactions. In Europe, we are still yet to see those ones.
So a high-yield bond issuance in Europe has had a pretty strong start to the year, but overall the market is still shrinking. How does that trend develop?
Yes, and it's basically, shrinking because, again, we have, we have the use of proceeds is effectively refinancing existing, issuances. You also have, spreads have tightened quite a lot. So, if you're an issuer today, maybe you issue more loans because you get the spread tightening, and you can also then get the benefit of the rates, the base rates, decreasing over time, even if we all, acknowledge that it's not going to happen as quickly, as we first expected, maybe same time last year.
There's also been quite a lot of turmoil, right? We're thinking of like Altis, Ardag, Intrum, three of the biggest, biggest cap structures in European high yield. Has that affected investor sentiment? Are there going to be, more fallout from this?
Yeah, so this is very good point, Francine. I think overall default rates are very low, right, across, I think, the markets, both in the US and Europe. We do have those pockets of stress, and they are very contained. I think that they affect companies that have been, very levered, and obviously, with interest costs going up, they have been, their cash flows have been more affected than for others. I would say generally it hasn't really affected issuance, investor appetite for, new issuance. But of course, I think, it means that investors have to work on their portfolios. And those, if you take those three, they actually represent quite a large, percentage of assets under management. And I would say every investor probably has some LTs and some ARDA in their portfolios.
So Hobie, talk to me a bit, we started by saying actually the IPO market is maybe the question mark. One, that deal making is picking up. When do you expect a resurgence of IPOs?
Yes, so IPOs, there have been already quite a few IPOs. Obviously it's the market in recovery. I think in Europe we've seen some large IPOs, Push, Douglas, CVC, Galderma. So, and when you look at the post, aftermarket performance of those IPOs, they've been quite, decent, I think, for the very large ones, which has been very good to see. But it is a market, is still in recovery. And I think that, I think people who look at IPO market, just take their time and sort of want to make sure that the story, is solid enough. Because I think for the good stories, there is appetite for equity investment as well.
What's the one thing, I know we talk about the Capital Markets Union, there's been a lot of political turmoil. Would that make a meaningful difference to attracting capital to Europe or for kickstarting deal making and more IPOs?
I mean, that would make, obviously, I think, yes, is the answer. I do believe that. I think, at the end of the day, what we really need is more stability, more issuances, in the IPO market. Obviously, now we are in a heightened, I would say, political environment, a little bit suddenly in Europe, given the past, sort of days. But overall, it seems like stability, volatility, has decreased, and we just need to see more of those IPOs, coming to market and performing well, I think.
Okay, private credit. Talk to me about private credit. I mean, it's an enormous amount of money.
Yes.
And actually, it's kind of come not out of nowhere, but it's incredible how big it is in the last 5 to 10 years. What are the pros and cons of private credit compared, for example, to some of the syndicated capital markets?
Yes, and look, we compare private credit a lot to syndicated capital markets. I think we're going to move away from that and just talk about how do we converge, how do we combine, and how do those two sources of financing sort of work together for just for the economy and for funding the economy's needs. And the reason why I'm saying that is that private credit has sort of started with replacing leverage lending at commercial banks just after the GFC, and it's really moved away from that to basically finance infrastructure assets, finance corporates for their large investments. And I think we're going to head more and more towards that, because when you think about the massive capex requirements for the new economy, so digitization, just decarbonation, a lot of money will come from, of course, there will be government money, there will be public markets money, equity and debt, but there will be private money as well, be it private equity or private credit. So I do think that as a bank, and we are obviously already working quite, seriously on that, is we are going to be working together with the private credit providers to meet those needs for our, core clients.
Hobie, thank you so much for joining us today. We need to do more of an update on this, maybe quarterly, if not almost monthly. Hobie Bouva, co-head of Capital Markets EMA at Deutsche Bank. Now, coming up, we'll also be hearing from the Greek Prime Minister, Kyriakos Mitsotakis, about the EU election results and, of course, the future of the European Commission President, Ursula von der Leyen. We're talking about some of the tumult in the markets since that election on Sunday. More from our exclusive interview next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Well, the Greek Prime Minister Kyriakos Mitsotakis has told Bloomberg that the political center held in the European Parliament elections, dismissing concerns about an upswell of populism. While speaking exclusively to Tom McKenzie, Mitsotakis describes the success of far-right parties mainly isolated to France and Germany. He also added that he's convinced that Ursula von der Leyen will secure a second term as European Commission president.
I am absolutely convinced that Ursula von der Leyen is going to continue as Commission President. She is our Spitzenkandidat. We are by far the largest political family, and I think she will have the overwhelming, if not unanimous, support of the European Council, and she will manage to obtain a majority at the European Parliament.
Well, that was Greece's Prime Minister Kyriakos Mitsotakis speaking to us a little bit earlier on. Now, also making news, President Biden says he will respect the judicial process and not pardon his son Hunter, who has been convicted in Delaware of violating federal gun laws. A jury found Hunter was addicted to drugs when he bought a gun in 2018. Now, he becomes the first son of a sitting president to be convicted of a felony and faces another criminal trial on tax charges just 2 months before the presidential election. Now, Bloomberg has also learned that the Biden administration is considering further restrictions on China's access to chip technology used for AI. We're told Washington may move to limit Beijing's ability to use cutting-edge chip architecture known as Gate-All-Around, or GAA. Apple shares rose to a record after it announced long-awaited new AI offers, overtaking NVIDIA as the second most valuable company in the world again. Now, Apple shares jumped more than 7% yesterday, their biggest one-day jump since November of 2022. Now, this is a picture for some of the French assets that certainly have been rocked around in the last couple of days. Now, the volatility that we saw in European assets for the moment appears to be subsiding. Investors were really rattled and caught unprepared for the French far-right's gains in the weekend's European Parliament. Calm could be short-lived. Let's have a look at, the France 10-year at 3.206. It could be short-lived because of a double whammy of US CPI and, of course, the Fed decision. Coming up, we'll speak to the World Economics Forum's managing director on the latest efforts to close the gender pay gap. That's next, and this is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts. Via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Now, U.S. stocks power to another record, but a rally in treasuries takes a pause as traders await a double whammy of U.S. inflation and, of course, the Fed decision. The French President Emmanuel Macron is set to address the public in the next half an hour after his shock decision to dissolve Parliament rattled the markets. Plus, the EU is set to notify Beijing today of tariffs on Chinese EV makers. Now, companies could face additional levies of around 25%. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the French President Emmanuel Macron will be holding a news conference within the next half an hour. It follows his decision to call a snap election that has really rattled the markets. Bloomberg's Caroline Conan joins us now from Paris. Caroline, great to speak to you. So where are we actually in terms of the potential outcome? What are the polls telling us? And why are the markets so worried?
In fact, the markets are going to watch very closely this press conference by Emmanuel Macron in half an hour to see whether he is going to manage to reassure, to take some of the heat out. Over the past couple of days, you've seen a sell-off on the French bond market. Clearly, what the market is really worried about at the moment is what happens if a national rally government comes into place after July 7? What does this mean in terms of French debt, French deficit? You know, in 2022, during the last presidential elections, the cost of a potential Marine Le Pen victory was estimated to be more than 100 billion euros. If you look at the deficit last year in France, it was more than 150 billion euros. So clearly, there is a potential here for a new debt crisis, according to the current French finance minister himself, Bruno Le Maire, a potential least trust moment, least trust scenario. Now, Francine, I don't have to explain to you what a least trust scenario obviously could mean, but a lot will depend on the horse trading behind the scene, what kind of alliances Macron will seek, what kind of alliances the National Rally will get, and with the Republicans, some of the Republicans at least joining forces with the National Rally, that could actually be a bit of a concern and a game changer for the second round also of these legislative elections.
Yeah, I hear, Caroline, from a lot of chief executives that they also don't know 100% what the economic plan, right, of Le Pen's party is. They don't know who they would put, you know, as finance minister if Jordan Bardella would become prime minister. But what are the polls saying in terms of what the outcome could be for the National Assembly?
So the polls at the moment are saying 35% for National Rally, 8% for Macron's party, but that's a two-round system. So again, a lot will depend on the horse trading, who supports who in the second round. Because of the two-round system, the two candidates who get the highest score in the first round, then they get to face each other in a duel for July 7 for the second round. Jordan Bardella, he is the one who would become prime minister if there is a majority of National Rally at the National Assembly. He's 28 years old. He's been groomed as Marine Le Pen's heir because she's still eyeing the bigger prize, which is becoming president in 2027. Yes, the economic program is pretty vague. We know, for example, that they want to nationalize highways. They want to lower prices of electricity by 30 to 40%. They want to lower the retirement age back to 62 or even 60 years old in some cases. That would itself cost as much as 30 billion euros, and a lot of other very costly measures, including, for example, some zero-interest loan for first-time home buyers. So all of this, of course, is great in terms of improving the cost of living on paper, but depending on how they're going to finance this, it's very unclear how they're going to finance all these costly measures.
Caroline, thank you so much. Caroline Conan there with the very latest from a pretty tumultuous Paris. Now, on to gender, and it could take up to 134 years for the world to close the pay gap between women and men. That's a warning from the World Economic Forum 2024 Global Gender Gap Report. Now, let's speak to the WEF's Managing Director, Sadia Sahidi, who, of course, is always instrumental in doing these reports and giving us the latest news on them. So, Sadia, thank you so much, as always, for joining us. 134 years, I mean, that's a lot. And last year, it was 131 years. So why are we going backwards?
Yeah, I mean, 5 generations and the year 2158 before we get to parity at the current rates of change. And I think there's a number of things that are leading to this continued stall. One is, up until 2 years ago, we were starting to get sort of a global all-time high of women in leadership positions at about 37.5% in the business world. And that has been declining over the last 2 years as the economy has been slowing down. So essentially, because there's less dynamism in some of those leadership roles and in some parts of the economy, there's fewer women going into those. Now, there is some hope, I think, for this year and next year, and that is because of the changes that are happening in political systems around the world. About 3 billion people are going to some form of local or national election this year and next year. And women in politics is, of course, one of the areas that needs some very significant transformation, where only 22% of that gender gap has been closed.
So, Sadia, is this because actually political representation from women in these elections is higher, or is it because some of the policies put in place could help women?
So I think there's a number of things that are happening. When it comes to local participation, only about 35% of that gender gap has been closed, but that is a lot better than some of the other areas. So women in parliament, all-time high, but only 33%. Women in ministerial positions, nearly the all-time high, but only about 24% of those roles are occupied by women. And when it comes to women in heads of state roles over the last 50 years, that's less than 15% for most of the world. So there's an opportunity here, given the number of countries that are going to elections. But of course, that opportunity is not just over this year and next year, but there has to be some consistent effort to have women in leadership positions. And this mirrors very much what's happening in various industries as well.
Sadia, I know that labor force participation has really gone down for women because of COVID, because they were carers more, because they stayed at home more. How slowly is that recovering?
So there has been a bounce back, nearly 4 percentage points compared to the peak of the low at COVID. And I think some element of this is that there was more of a recognition that care systems matter. And that's there's more economies that are putting some structural changes in place in relation to that. There's another element, which is the overall shakeup that is happening across so many different industries because of the rise of artificial intelligence and what that then means for women and men's participation in the economy, but knowing that more women-dominated roles are being disrupted. So there's more efforts now being put in place when it comes to upskilling and reskilling women, but more, of course, needs to be done. And there's, again, a piece of good news, which is when it comes to AI engineering, which I think we'd all agree is going to be one of the key roles that's not just growing in the future, but shaping the rest of the economy. In that role, there's been a doubling of female talent between 2016 and today. Of course, that's still half when it comes to men, but that is a very positive sign. The pace of change has been very similar to men going into those roles.
And Sadia, again, this is hugely important, right? The fact that you say since 2016, female representation in AI engineering has doubled. But does that help with algorithms? Does it help in boosting female participation in all? Or is it just because job creation will mostly come from AI-related jobs and therefore also AI engineering?
I think it's both. So one is, of course, this is a major growing sector of the economy. And the more first movers there are going into that particular space, the better it is. And of course, it's important that there's more parity built up in that sector simply because that's one of the growing roles. But the second element is the outsized impact that it has on everything else. So how some of those decisions around practices and policies and biases and governance of that data how all of that looks, if those decisions can be made in a more gender equal way, then the impact that it has on the rest of the economy will also tend to be one that is more gender equal.
Sadia, as always, it's a very well-written report because it's also very clear that you're focusing on 4 key dimensions: economic participation, opportunity, then educational attainment, health and survival, and political empowerment. What are you, out of those 4, most optimistic about?
Yeah, so I think there has been some progress when it comes to economic participation, and there has certainly been progress in learning what works. And that is where care systems, more targeted focus on the STEM sector, more targeted focus inside organizations, recognizing that there's a win-win here, that integrating more gender-balanced teams is going to lead to greater innovation and creativity. The richness of the lessons, I think that can only help, and the transferability of those lessons is quite high between different businesses and different sectors and between different countries as well. So there's a lot to be learned from what we've picked up here over the last 18 years that we've been tracking this particular index, but it still requires a lot more targeted action, both by CEOs and by governments.
Sadia, as always, thank you so much for joining us. Sadia Zahidi, the Managing Director at the World Economic Forum, with a really important global gender gap report that I urge everyone to read. You can find it online. Now, coming up, the Conservative Party unveils its manifesto. We discuss where it leaves the opposition with Dale Vince, founder of the green energy company Ecotricity and Labour Party donor. That's coming up next, and this is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, the UK Prime Minister Rishi Sunak has put tax cuts at the centre of the Conservative election manifesto. Now, that's as he tries to turn his party's fortunes in national polls ahead of the 4th of July general election.
I'm not blind to the fact that people are frustrated with our party and frustrated with me. Things have not always been easy, and we have not got everything right. But we are the only party in this election with the big ideas to make our country a better place to live.
Now, the opposition has called it a, quote, desperate wish list. Labour will unveil its manifesto on Thursday. Joining us now, I'm very excited about this interview, Dale Vince, founder of green energy company Ecotricity. Vince has donated more than £5 million to the UK Labour Party. So, Dale, thank you so much for joining us. I mean, I don't know whether there's anything can happen, people tell me, in the election, but actually Labour are so far ahead in the polls. I mean, is there any chance that they don't bring this home?
I think that, there's a chance that people see it exactly like that it's a slam dunk and they don't need to go out and vote. I think that's the one danger perhaps facing Labour. I think other than that, the Conservatives' record in office is so terrible. Their campaign so far has been pretty terrible. And the polls are reflecting what people really think in our country. But it is important that people get out and vote.
Okay, so you're a Labour supporter, you're a Labour donor. What do you think they need to do with the net zero policies? So they've kind of rolled back on some of the commitments, their spending plans. Can they go back? How do they kind of navigate and also bring back private investments?
Yeah, I think private investment's never really gone away, except when the Conservatives banned onshore wind, and then private money couldn't go into that. But it's gone into other things. There's no shortage of private money wanting to invest in net zero, because actually it's the most economic form of energy, for example, that we can make from the wind and the sun.
But with a government that says, look, I'm going to put an extra 28 billion, I mean, that helps private money kind of match that or come in with more gusto.
It could do, or it could be seen as a competitor. But the thing I always say about onshore wind and solar is it needs no public money. And so this talk about the 28 billion that was rowed back onto, like, it was either between 5 and 12, depending on who you listen to, whatever it was. My point is that we don't need public money to get to 100% green electricity on the grid. Let's use it for something else.
Okay, so you don't think there's no concern that actually there's less commitment from Labour on net zero? You think they're serious about it and you would support their plans on this?
Yeah, I do. I think they're completely serious. I think they get the opportunity of the green economy, and they have this most ambitious plan to be 100% green electricity by 2030, for example. That's not a road back at all. I mean, I think that's very ambitious.
Is there anything that you wish they would do differently or be more clear about?
Not really. I understand where they're at. I mean, until a couple of weeks ago, it was pre-election, and there was a lot of pre-election scrutiny. Now we're in the actual election. I think we'll see more boldness from the manifesto when it comes out. Yeah. And I think it's just a matter of time now before we see Labour actually starting to do things. Obviously, a couple more weeks, hopefully they'll be in government and we'll see what they've got. And I'm very confident that they really will move heaven and earth to get to net zero and to rebuild our economy, because that's what the green economy, offers us, the chance for jobs and GDP growth.
So, Dale, what do you think the relationship of the Labour government is with businesses right now? We know that Rachel Reeves has gone the rounds. She's termed a lot of the businesses. She said, look, nothing really changes. There are questions on private equity, on some of the things that they could do on net interest income, the 2%. Like, how do you see that playing out?
I see it as quite fine. I think business sees Labour as the next government, as the credible party in the room. The Conservatives have lost that mantle some time ago. I think tax on private equity and stuff like that, I think that's fair, right? We should close tax loopholes. Let's face it, the very richest people among us can't afford not to have these tax loopholes. I don't think that will put business off Labour at all.
Do you think they'll stay here, or do you think they'll move abroad? This is always a question. It's like if you want to make it fairer, that's great, but the rich may move elsewhere.
Yeah, I'm not really worried what the rich do in terms of being here or being abroad. I think if there's an opportunity here to make business, to make money, then there'll be enough people here to do that, and the opportunities will be here under a Labour government.
But so do you care, for example, what they do about private equity, or does it not really? You're a businessman. I mean, you created, a company that has done very well. What would you need to start a company over now under a Labour government?
I don't think there's anything different. I mean, we were part of a team that took this current government to court over the private equity tax loophole. So I think it should be closed. I think that business should pay more tax than they do. I think rich people should pay more tax than they do. Excuse me. And that won't disincentivize people to get out and start businesses and make money. It's still a wonderful opportunity, particularly when we have a government that unlocks the potential of green energy. Onshore wind has been banned for over a decade, for example, which is a travesty.
Is there, again, there's a lot of concerns about, what happens to this country in terms of a growth plan, right? Because finances are so tight. What would you do as a blueprint for the UK to grow in the 5 to 10 years to come?
Well, I would invest in green energy, not just electricity, but gas as well. We have a massive opportunity to make the gas we need from grass instead of having a heat pump program. And I would do as Labour planned to do, get to 100% green electricity as fast as possible. We commissioned a study, and it shows that for every pound we put into fossil fuels, we get twice as many jobs and twice the GDP growth if we put that money into renewable energy. It's a wonderful opportunity. That's what I would do.
What do you think this election is about? Is it about personalities? Is it just that people are fed up with the Tories, or do they actually like Labour policies and the leader?
I think it's always about personalities, and I think absolutely people are fed up with the Tories. They have had 14 years after all, and I think they've shown themselves to be a party now that's run out of ideas and run out of talent, and I think they need a period in opposition to rebuild themselves. I think that happens periodically in English politics, maybe in all politics, I don't know. Are the country in love with Labour's plans? I don't think completely. To be honest, I think, the Conservatives have really kind of lost this election more than Labour currently have won it, but I'm hoping to see some exciting stuff in the manifesto.
So I was talking about excitement, and actually it's a good point, is that I don't know if Labour have it in terms of, does Keir Starmer need to be have more fire in the belly? This is maybe the point that people make the most.
Yeah, it's said about him a lot, isn't it? But I think there's a whole bunch of people in our country that just want a solid leader, somebody reliable that they can depend on, not somebody that's exciting like Boris Johnson, whom you couldn't trust, actually, or somebody like Rishi Sunak, who never really speaks the truth.
Chips are vegan. I need to ask you about chips are vegan. This is literally just because people don't realize that chips are vegan.
Yeah.
And tell me about the T-shirt.
Absolutely. Along with a lot of every other day foods. I run a football club, a vegan football club, and I was doing an interview with our new manager, and the interviewer tried to bowl him a difficult question. Have you eaten any vegan food? And he was like, I don't know. And I said, chips are vegan. And he's like, chips are vegan. So
and the T-shirt's been made. There you go, Dale. Thank you so much for joining us. Dale Vince, founder of green energy company Ecotricity and Labour donor. Now we'll have much more, of course we will, on the upcoming UK election on our weekly UK show at 9:30 a.m. London time tomorrow. Now, coming up, the EU is set to push ahead with EV tariffs on China despite concerns in Berlin. We discuss the latest from Brussels and what it means for the global auto sector. That's coming up shortly, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Now, the European Commission is due to notify Chinese EV makers of provisional tariffs today. Now, according to European officials, companies could face additional levies of around 25%. That's despite concerns from the German government it could trigger a costly trade war with Beijing. Well, Bloomberg understands that numbers have still not been finalized. The move was widely expected, with EV makers the biggest losers in the Hong Kong session. Let's bring in Bloomberg's global autos editor, Craig Trudell. Craig, always good to have you on TV. This is a moving story. It's a big story, and European governments are definitely divided. So what's the latest from the auto sector? What do they want?
Yeah, there's a lot of potential for this to go sideways. That being said, there's also still questions about, just how much Chinese manufacturers will be able to sustain this blow, to what extent they've been pricing their vehicles sort of strategically to try to avoid this level of scrutiny and maybe have a cushion to work with to bring the starting prices down and still be able to sell competitively, even with something like a 25% additional tariff. So there are a lot of question marks here and a lot of moving pieces, but the likelihood or possibility of retaliation for China means that it's kind of a negative story all around, right? It's a blow to the Chinese companies, but also something that, as you mentioned, the Germans are quite worried about.
So does China retaliate? Does China, do they care about the amount that the tariffs are set at, or is it just an affront by just putting something on them?
I think it's an interesting thing because China does have way too much capacity and is sensitive to the idea that Europe is not only a place where a lot of cars are purchased, it's also a place where they can get top dollar for the cars that they export. So I don't think that Beijing wants to overdo it here in terms of retaliation, but we've already seen them, allude to this possibility of maybe that they would retaliate with tariffs on cars with large engines, which would hit German manufacturers that still ship a fair number of cars from Germany into China.
Craig, very quickly, BNEF used to think that EVs were good for the climate. Now there's question marks.
It's really a compelling report today, about 260 pages worth of analysis on the state of the EV market, how much EVs are slowing down, plug-in hybrids sort of picking up some of the slack, and some questions about just how good those are for the climate. But it's absolutely the case that the industry needs to accelerate in order to get us to net zero. And right now, the momentum has really stalled.
Craig, thank you so much, as always, for joining us. Craig Trudell there on autos and EVs. Bloomberg Brief, that's up ahead, and this is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry
at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Double trouble. Markets brace for volatility from the latest CPI data and a Fed decision coming less than 6 hours apart. The White House weighs more chip limits to China while ramping up Russian sanctions to include semiconductors. And Oracle extended gains after better than expected earnings and partnership deals with Microsoft and OpenAI. 3.5 hours until Act 1 of the big play today. It is CPI that gets released. 0.3% is what we're expecting on core. 6 hours later, Jerome Powell takes center stage. S&P 500 futures easily extending to new highs yesterday. Not too much action this morning as we await the data. It was thanks to Apple. Apple finally at $3 trillion yet again. A big old rally yesterday, the best since 2022 after their AI announcement, their partnership with OpenAI. There kind of seems to be a theme here. Oracle announced a similar partnership yesterday that also helped their shares pre-market this morning. U.S. 10-year yields little change. We're at 4.4%. It was a rally yesterday. Perhaps concerns about what's happening in Europe, but also a strong bond auction. Are the auctions okay? Are we fine with more supply just as long as inflation is behaving itself? Euro, that's also a little move this morning. 107 is where we stand. Perhaps the most interesting market continues to be the French bond market. Bonds getting pummeled. The spread between France and Germany, 62 basis points. Bruno Le Maire, the French finance minister, is warning of a Liz Truss moment if Le Pen emerges victorious. What does that mean for the ECB? Are we talking about a de facto easing because of politics? Again, poor Liz Truss, always being used as the example for what you want to avoid. So it is that double dose of economic news we're bracing this morning. Both CPI and a Fed decision are coming out today. Again, 3.5 hours is when we get CPI. We are on edge this morning, even though markets are a little changed. Let's get now to Bloomberg MLive reporter Noor Al-Ali. Noor, set it up for us. What are we expecting?
Good morning, Danny. Well, it all comes down to that core CPI reading, and what it will say will really dictate how markets view the Fed. I mean, reminder, the FOMC meeting is underway, and the Fed's data dependence makes it really, being held hostage by those monthly readings. And so if we do see that CPI reading, particularly on the core front, confirming that it is in fact easing and not a blip from what we've seen in the last month after after those really hot and sticky prints in the first few months of the year, then that should set up the Fed for a dovish, at least take that markets will take, and then carry that rallying that we've seen in treasuries on the back of that really good 10-year auction that we saw yesterday. So incredibly exciting, especially also into the BOJ meeting on Friday, where the yen then will become on focus. So a lot for markets to factor in just into the weekend, Danny.
Yeah, Noor, thank you for bringing up the BOJ. I know today's exciting, but we can't forget them on Friday. Noor Ali there from the Bloomberg team. Noor talked about the excitement of today. Here's someone who's throwing some cold water on it. Paul Donovan of UBS, writing in his morning's note that economists are overstimulated by the U.S. today. We have the excitement of U.S. CPI, a Fed decision, and that Fed Chair Powell's press conference can be relied upon to dampen economists' passions. The Fed is unlikely to change policy, and the fabled dot plots of policy projection will add confusion. A black mark on a chart gives no sense of confidence or risk. Well, lucky for us, we don't have an economist today. We have a voice of reason. It is Banu Baweja, chief strategist at UBS. Banu, there you go. Paul Donovan saying other economists, they're too overstimulated on today's data. What do you think? Are we hyping it up too much? How much does it really matter? The double dose of CPI and Powell.
Well, look, it does matter, right? Because, I mean, if today the Fed changes their dots from 3 to 1, they effectively shut out the possibility of rate cuts all the way potentially till December, right? So you have a rate cut that they will not do in July or in September or in November, and then we have to wait all the way till December, because again, November meeting comes just 2 days after the presidential election result, and it's going to be quite hard at that time to move on rates. So it does matter. However, I will say this, right? We are expecting a fairly benign report for CPI, which, as you call, was the Act 1. So we're expecting 24 basis points on core, which is below consensus. Consensus is around 29 to 30 basis points on core. And while we don't really speak about the headline, this time actually the headline could be quite important as well, because we're expecting 8 basis points on headline. Only 8 basis points. This is, of course, month-on-month data. And the reason we're expecting such a benign number is, of course, because gasoline prices are coming off. And on core, we're expecting vehicle insurance prices and OER. These are the two components of CPI that have been very hot for some time. OER, for the first time, is going to drop below 40 basis points in about 3 years. And that we think the Fed is going to have that information Tuesday night before they would have made the decision today. So we think this is going to mean, on balance, that we get 2 cuts this year in terms of the median dots, and that will be consequential. But if we get 1 cut, I think we can forget about rate cuts all the way till December. What does this mean for markets? Well, we do think that the 2-year still has extremely good risk reward to receive. At about 485, the markets completely ignored the previous CPI print. If the Fed is not hiking, and we don't think they are hiking anymore, at 485, 490, we think it's very good risk reward, regardless of today's decisions, to actually receive the 2-year.
Yeah, it's something that PIMCO has called a generational shift, considering where we are with higher rates. Banu, a lot to unpick there. Let's just tease out that point a bit, because the flattener trade, much like this being the year of the bond market, hasn't really played out. It is a front end that's been scared of the Fed, and it is a long end that's been concerned about the economy. So are you saying this is a flattener trade, or do you expect that the 10-year yield also will be coming down precipitously with the 2-year yield?
Danny, it's a steepener trade, right? Because we think the 2-year is going to, we think the 2-year is going to do more than the 10-year. But to your point, the 10-year is also going to come down. The 10-year is about 440. We think we can get about a 20 to 25 basis points decline in yields at the 10-year by the end of this year. But on the 2-year, you could potentially see about a 75 basis points decline in yields. So while the curve is sort of inverted in nearly 40 basis points to stand, you can see by the end of this year that we can see the curve becoming absolutely flat. And then into next year, the curve becomes steeper. Many people have been worried about the curve bear steepening. I mean, there's a little bit of technical jargon basically saying that the 10-year is going to sell off. And as a result of that, the curve is going to steepen because of fiscal worries and so on. And while fiscal worries are relevant, well, we think inflation or the cycle is the bigger driver. And as inflation comes down, the decline in the 2-year is going to dominate, and in fact, the gravity of the 2-year is also going to pull the 10-year lower. Less than the 2-year will move, but nonetheless, the 10-year will also come lower, and therefore, we think bond positions are fairly attractive at these levels. We would agree with PIMCO that these are good levels to buy bonds. I say that just ahead of the CPI report, and it's quite a risky time to do that. However, I do think that even if the CPI report isn't as benign as we expect, at these levels on the 2-year, and given what's priced in for real rates today until infinity, basically all the way in the forward space, real rates are above 2%.
Well, Banu, I'll tell you why it's not as
attractive.
risky this time. If you look at the stats over the past 2 years, 88% of the time, 10-year yields have fallen after a Powell press conference. 2-year yields have dropped 76% of the time. That's a trend that's persisted this year. Presumably it is because Powell has this dovish bias that every time he talks, he turns around markets because he has this proclivity in order to cut. He wants to see those cuts. So how much can you really predict the moves of today? Saying that, you know, inflation will come in a certain number is one thing, but actually knowing how this market reacts is a completely different thing, Banu.
That is true. I mean, but I think we really have to ask ourselves one salient question. Can the Fed hike from here? Now, there was some discussion in the recent FOMC minutes that that's a possibility, but as you said, Powell has actually ruled it out in his own comments. I mean, he doesn't seem to think that monetary policy needs to get any more restrictive. Remember, the unemployment rate is at 4, Naira is at 4.1, so you're within touching distance of the unemployment rate relative to equilibrium. Core PC is not a million miles from 2.5%, so soon you're going to have inflation settings and unemployment settings which are actually close to equilibrium neutral, whereas policy is nowhere close to neutral. Policy is very restrictive, 2%, 2.25% real rates, and that's why the Fed doesn't think that even if we get higher inflation here, that we need actually tighter monetary policy. They will just keep monetary policy restrictive. If that's the case, then the 2-year can't rise more than 5, maximum 5.10. We are trading 485 to 590, and therefore the risk reward is you lose 20 basis points, potentially for 75 to 80 basis points gain, which I think is a very strong risk reward in the 2-year.
Okay, Banu, you're going to stick around with us. Banu Baweja of UBS. Let's first get some of the top stories trending on the terminal this morning. The UK's economic recovery has stalled in the run-up to the general election. GDP was flat in April compared with the previous month. Economists had, though, expected a 0.1% drop in output. It is a setback, though, for Prime Minister Rishi Sunak, who had been campaigning on evidence that the economy is turning a corner. Meanwhile, in China, consumer prices rose less than expected in May. Factory prices dropped as well for the 20th month in a row. The still weak prices have fueled calls for more government action to shore up demand. BlackRock CEO Larry Fink and Microsoft CEO Satya Nadella are among business leaders headed to Italy to participate in the G7 summit this week. Bloomberg has learned that the executives were co-hosted by President Biden and Italian Prime Minister Giorgia Meloni to support a push to invest in developing countries. We also just got a line from the G7. The G7 has called on China to stop enabling Russia's war machine in Ukraine. Speaking of which, Biden, anticipating this, has been looking to put the squeeze on Putin's access to semiconductors via China. We'll have the details for you. And then later in this hour, we're going to catch up with Citi's Veronica Clark on why the bar for cuts is lower than the market assumes. That's all to come on Bloomberg Brief.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
It's your Bloomberg Brief. I'm Danny Berger in New York. So the G7 is gathering in Italy. They've issued their first statement, a statement saying that China essentially needs to stop supporting the Russian war machine. Now, to that point, in anticipation of the G7, the U.S. is widening sanctions on the sale of semiconductors and other goods to Russia. It's targeting third-party sellers in China and elsewhere as it looks to squeeze Putin's war machine in Ukraine. Hours before we learned that, we also learned that the U.S. is weighing more sanctions on China specifically, not sanctions, rather, limits on China's access to chips that are used to build AI. Let's bring in Rebecca Chung-Wilkins, our reporter in Hong Kong. Rebecca, clearly the U.S. sees that they have a strong lever here, that they can really pull chips when it comes to being hawkish with China and at the same time trying to limit what Russia is able to do. The question is, how wide are these and how effective are they?
Yeah, absolutely. In some ways, this sort of, fills the circle of U.S. foreign policy, both on the one hand, trying to limit strategic technologies and access to that from China, but also trying to squeeze and pressure China more to help and do more when it comes to restricting Russia's own access to what it says are, shipments related to its war machinery, particularly with this focus on chips. Now, these widened restrictions that you mentioned, that will also include, for example, identifying by address entities that the U.S. alleged have been linked to and involved in these reshipments of chips to Russia. So really the latest set of sanctions are about trying to move away from goods that are just in U.S. origin, but all of the things that are happening along that supply chain and these sort of so-called reshipments and rerouted goods. Now, the U.S. repeatedly has expressed some amount of frustration. It's asked Beijing repeatedly to do more. And, in some ways that reflects the difficulties in their position here. It is worth pointing out, however, that trade between Russia and China, or exports rather from China into Russia, fell by about 14% so far this year. And we've also had this sort of drop-off, reported drop-off in the number of Chinese banks that will allow Russian entities to move money. So we have seen some responses on the Chinese side that perhaps this sort of threat of repercussions is actually rippling through.
Rebecca, quickly here, because we're almost out of time. There's also more tariffs, more restrictions coming from Brussels, this time on Chinese EVs. We've been waiting to see what Brussels' response will be. They're likely to announce a 25% tariff. What does that mean for China in a market that has a lot of overcapacity and had planned on putting much of that into Europe?
Well, in short, this would really be a blow, particularly if we see it on the higher end, 25% or anything higher, really above than 20. This is arguably China's most important export market for EVs. And EVs are absolutely critical to what China calls the three new drivers of growth that are intended to underpin the new model and the new generators of growth as we see property in decline.
Okay, Rebecca, thank you very much. Bloomberg's Rebecca Chung-Wilkins. Okay, I want to get a quick check on Oracle this morning. One of the big stocks moving in the pre-market, up some 9% this morning. It had reported that bookings beat expectations, and it also announced a partnership deal with some of its biggest tech rivals. OpenAI was one of the words ushered in that. There seems to be a theme here, not just Oracle jumping on an OpenAI partnership, but at the same time, Apple, $3 trillion. Let's get back to Banu Buweja of UBS. Banu, I know you write that equity markets are running ahead of their drivers. Either drivers need to change or tactical correction is likely. We'll get into that in just a moment, but one of the drivers clearly here is AI. One could even argue OpenAI and partnerships. How much longer does that driver have to run?
You know, we're not chasing sort of the Magnificent Seven within that, because we think that the AI narrative, strong as it is, has probably run a little bit ahead of itself. This is not to say that broader tech can't do well, but particularly the AI narrative. And again, you know, this is relevant for the medium term, but we are skeptical that we are in the midst of a productivity boom right now, right? I mean, quite the contrary, where you see in the US, consumer demand is slowing down. The overall economy is slowing down and employment is extremely strong. That actually speaks to weaker productivity, not stronger productivity. So at this minute, we're not chasing the Magnificent Seven. We're not chasing so much the AI theme. At the same time, because life's never simple, at the same time, we have lower real interest rates penciled in, because we have lower inflation penciled in, and lower real interest rates do help technology. So we do like the broad technology sector, and we are long in China, we're long in Korea, we're long in Taiwan, we're long in parts of Europe in technology, also in parts of the US, but we're not necessarily chasing just the AI theme, which is something that we have been on for some time. But at this minute, we're taking a step off in not chasing NVIDIA very aggressively at these levels, and broadly for Magnificent Seven as well. It's quite nuanced. It's not a buy situation.
Not a buy situation. What needs to change? What sort of drivers need to change to get you excited about this U.S. equity market? Because you say either that or there's going to be a tactical correction. Just from hearing what you're saying, Banu, with the slowing of productivity, it sounds like you're more towards the tactical correction camp.
Well, I do think that first you're going to get help for the market arriving from the fundamentals in the form of lower rates. We spoke about lower inflation. We spoke about lower rates. I think that will help the market first before weaker growth creates enough headwinds that the market comes down. So in the near term, over the next month or two, as we get bond markets rallying, that's dependent on inflation rates coming lower as we expect. Again, 24 basis points today on core inflation below consensus. And that should mean that the two-year rates, there's not a lot of debate on 2024. The debate is in 2025, where, you know, we think the Fed is going to cut much more aggressively than the markets are priced for. And that should mean that two-year rates come down now. And that should help the market. It should help utilities. It should help consumer discretionary stocks. It should help tech. But beyond that, there are very clear signs that the U.S. consumer is tiring. So that fatigue of the U.S. consumer will mean over the medium term that earnings expectations will probably be found out to be too high, and that's when the market corrects. So interest rates help first, growth hinders second.
Right, and you like European and Japanese consumer stocks over U.S. consumer stocks. Banu, I mean, if we had talked about this a couple months ago before this earnings season, I would have said you're crazy. The U.S. consumer keeps buying. But the earnings season did show some weakness in names like Starbucks, Walmart, people trading down. When does it get from these slight cracks in some of these earnings reports to something actually bad, something actually that points to either economic weakness or even recession for the consumer? And just less than a minute here, Banu.
Yeah, look, I mean, let's define bad. There is no balance sheet problem, okay? There, however, is an income statement problem. Real disposable income in the U.S. is growing close to zero, and the markets are paying attention. Consumer discretionary stocks in the U.S. have underperformed staples through the course of this year, and that's what we're hearing also from all the bottom-up indicators, Nike, Walmart, Dollar Tree, and Dollar General. All of them are telling us that the U.S. consumer is fatiguing. Europe, Japan, the other way around.
Okay, Banu, thank you so much. We really appreciate your time this morning. Banu Buweja of UBS. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some of your front page news, a look at what's making headlines around the world. First up, Washington Post leads with this. President Biden saying that he will respect the judicial process and he will not be pardoning his son, Hunter, who yesterday was convicted in Delaware of violating federal gun laws. In that, a jury had found that Hunter was addicted to drugs when he bought a gun in 2018 and had lied about it in order to get that gun. He becomes the first son of a sitting president to be convicted of a felony. He also faces a criminal trial on tax charges. That will happen just 2 months before the presidential election. Next up, we have this. Elon Musk has dropped a lawsuit alleging that OpenAI and its CEO Sam Altman breached a founding promise last year. Musk didn't provide a reason why. Finally, let's get to Paramount. This is leading on the Wall Street Journal that Sherry Redstone has ended discussions to sell her controlling stake in Paramount to Skydance and merge the two companies. It's been months of drama, of negotiations. It's been one of the messiest deals to play out in recent years. Okay, coming up, we get back to the drama of today, CPI and a Fed with Veronica Clark.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up the, we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our global headquarters in New York, I'm Danny Berger. Manus Cranny is out on assignment and also probably on a beach somewhere. Let's set your agenda. It is double trouble. Markets are bracing for volatility from the latest CPI data and a Fed decision. They come less than 6 hours apart. The White House weighs more chip limits to China while ramping up Russian sanctions to include semiconductors. And Oracle extends gains after better than expected earnings and partnership deals with both Microsoft and OpenAI. It was the OpenAI effect on this market. Oracle gaining nearly 9%. Apple yesterday back at a market cap of $3 trillion. All of that was enough to lift us up to a new record. S&P 500 futures up 0.1%. But in 3.5 hours, you get the first act of the show. It is CPI. Then 6 hours later, Jerome Powell takes center stage. For now, yields little change. We are under 4.4%. A rally yesterday led by maybe the concerns in Europe, maybe a strong auction. Speaking of concerns in Europe, euro little change this morning, stronger by 0.1. 107 is where we stand versus the dollar. It is French bonds that have sold off dramatically. 62 basis points is the gap with Germany, the widest in quite some time, the widest since October of 2023. So again, it is concerns over the French election. Emmanuel Macron is speaking right now. We'll bring you any lines that come from that. In the meantime, we need to focus on the event of today. The events, I should say. And on that, Veronica Clark, U.S. economist at Citi, writes that the U.S. labor market is loosening while inflation is set to come in cooler, and the Fed is willing to cut if either of these trends become more pronounced. We continue to think the bar for cuts is lower than the market is assuming, particularly if the unemployment rate continues to rise. She joins us on set now. Veronica, thank you so much for joining.
Thank you for having me on this busy day.
Yes, a very busy day. So thank you for coming in on the busy day. Yeah. So, okay, assuming that we get somewhat of a benign inflation report this morning, are you expecting to hear a Powell that is really championing cuts to come?
I don't know if he's going to, guide towards cuts at a coming meeting necessarily, but I do think he's going to leave all options on the table. I don't think he's going to rule out a cut as soon as July, which I don't think anyone is expecting that. We are now expecting the first cut in September. But I think he is going to sound more concerned on the labor market than maybe people are assuming. Obviously, we had a very strong payroll job growth on Friday, but I don't think the Fed is going to love that the unemployment rate is gradually ticking higher and is now at their year-end forecast. I think that's going to be a concerning sign for them.
I mean, but there's been thoughts out there, maybe the unemployment rate is higher because of different factors like immigration, things like that, but just the jobs number in itself is strong enough. So what do you say to those folks?
Yeah, there has been this very strange divergence between the two surveys of employment that we have, the payroll survey and then the household survey that determines the unemployment rate. The truth is maybe somewhere in the middle. There is this idea that maybe it's strong immigration that's showing up and boosting those payroll, very strong payrolls figures. And it does seem after we had that 272 on Friday, it's probably unlikely that we're going to get a sharp enough slowing in the one print before July that the Fed will be cutting in July. But I do think the ratio of unemployed to labor force in that household survey, there's no real reason to believe that even if the levels are mismeasured in that survey, that the ratio is wrong. So I do think they're going to be concerned that unemployment rate's ticking up.
Okay, so we might hear Powell say that, which I think would be a change for this market and maybe awaken some animal spirits. It is clear that it is a Powell who has a bias towards cutting. The question is whether the rest of the FOMC, share that proclivity, because you have heard the Neil Kashkaris of the world come out and be much more hawkish than Powell. So even if he wants to cut, starting in September and then cut from there on out, can you get the backing from the rest of the members?
Yeah, I mean, it will come down to inflation data, of course, also, and we've heard from some of the more hawkish members like Governor Waller, need to see several months of inflation data. That's probably more than the 2 that we're going to get before July, so today and 1 more. But I think that's somewhere around 3 or 4 months. And I think we will see things like shelter inflation that are slowing. And I think one common factor among Fed officials is going to be that if you do see a nonlinear weakening in the labor market, they will react to that. And we are maybe on the precipice of that now. I think this is a labor market that the Fed will still describe as in better balance, looks a lot more like 2019, but you are verging on the border of an uncomfortable weakening.
That's really interesting. I mean, when do you really see that manifesting itself, if it's just, again, a little bit uncomfortable right now?
Yeah, I mean, it can happen pretty quickly. What we know about the labor market right now is that businesses have definitely slowed hiring, pulled back hiring. Hiring rates are at 10-year lows. You see that in survey data. You see hours worked declining. You see part-time employment increasing. To us, that feels like every step to cut labor costs other than laying people off. But we have had a pullback in spending in the last couple months. We hear that in the consumer equity earnings calls, retail sales that have been softer. If revenues start to pull back now, maybe you need to do that more extreme labor cutting cost and lay people off. And when that starts to happen, that is that nonlinear weakening of the labor market, and these things can build on each other pretty quickly.
Does it get bad enough that we start talking about a recession again?
Yeah, no, absolutely. I mean, that is the scenario. In the 80-year history of the unemployment rate, if you go back, full 80 years, the increase that we've had in the unemployment rate over the last year, we've only seen that 13 other times, and 12 of them were recessions.
Okay, so that is a shift, right? Because people have been talking about a soft landing. Does that mean you're not in the soft landing camp?
We are not in the soft landing camp.
Yeah.
We are penciling in this, much more abrupt softening of the labor market, a couple quarters of negative GDP growth, further pullback in consumption and investment. We are penciling in a recession.
I mean, Veronica, it is very different than what's out there right now. I was just looking at Deutsche Bank, which just revised their 2025 assumption for what the dots will be, and it basically saying, actually, the dots will be 25 basis points higher, that there will be 25 basis points less of cuts than we were expecting because of the data coming out. What does 2025 look to you in this scenario where you do see growth starting to decline?
Yeah, we have the Fed cutting every meeting after they start cutting. So there's obviously a lot of uncertainty around when that actual start is going to be. But I think the labor market backdrop at that point is going to be enough that the Fed's cutting every meeting. So that for us in our forecast is 125 basis points total for 2025.
Right.
75 for this year, so 200 basis points total. Getting back to something that looks a little bit more neutral. But even then, in a recession, you would maybe expect the Fed to be cutting even more, but you'll have the issue where there is still this stickiness to inflation still.
You're not saying stagflation?
No, not stagflation.
Or are you?
No. I mean, you will maybe have a period that looks a little stagflationary because the normal cycle should be that rates go up and demand slows, activity slows, and then with a lag, inflation slows. And so I think that's what will happen. Something closer to 2% for sure, 2.3. But are we going back to a nice steady 2% in the long run? That looks a little bit unlikely right now.
I wonder what the danger is in that, because we have a Fed right now who, as they say, are data dependent, and they're reacting to every single data point. If there is continuously this lag where the economy is starting to turn, but at the same time inflation at least appears to be sticky, is that right for a policy error, that the Fed doesn't act as quickly as perhaps they should?
Yeah, I mean, I think they'll be measured in how quickly they're cutting rates. This is not a recession where the Fed has to cut to zero, I don't think.
Right.
So it will be maybe slower than people are used to in the past recent recessions. Quick cutting to zero is probably unlikely. But 25 a meeting is reasonable, I think.
Does fiscal policy make a difference to you, depending who's in the White House?
Yeah, I mean, certainly in the near term, fiscal policy has been a really important driver of activity. I think that's a real important reason why this lag of monetary policy is taking longer to work its way out into the economy. We've had very supportive fiscal policy over the last couple years. And that looks to be peaking for this year, at least. And then, yeah, as we're getting into, post-election, 2025, obviously a lot of uncertainty around what policies will actually be. But it does seem like fiscal will remain pretty stimulative.
Okay, Veronica, it's great to talk to you, not just because it's contrarian, but you have a clear view of 2025, which I think a lot of folks are struggling with. So it is refreshing. Veronica Clark there of Citi. Okay, coming up, keep your friends close, but your enemies closer. Oracle signs a partnership with some rivals, including Microsoft and OpenAI. We're going to have more on that for you next here on Bloomberg Brief.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It's your Bloomberg Brief. Danny Berger here in New York. Paramount shares, let's get a check on them, declining in the pre-market trade this morning, down 2.25%. Its chair, Sherry Redstone, has dropped her bid to merge her family's media company with Skydance. For more, let's bring in Bloomberg's Kimberly Adams. I mean, Kimberly, this has been so much drama. Of course this is how it ends. Of course they just dropped the bid completely. How did these discussions break down?
First, there was a meeting that was supposed to take place. Then all of a sudden, Sherry said, the deal's off the plate. We're not going to talk to them anymore. Now, we know this is happening now, and it's a shocker because for months, she pushed this deal. She said that the deal with this company would be good for the company and her family, and that this company, Skydance, would maintain her company's, her family's legacy. And here we are right now, and it's nowhere. She all of a sudden said no. A lot of it has to do with the fact that she had a lot of pressure coming for her from the owners, not the owners, excuse me. She had a lot of pressure coming from the shareholders and other managers in the company. They just did not want this deal at all.
Yeah, they didn't want this deal. They said, look, it favors you so much. You get all this sweetened terms. What do we get?
Right.
And there had been other deals. There had been other proposed deals, I should say. Apollo, Sony, people saying, look, maybe we can do it better. Is that what's next for Paramount, or is this a Sherry Redstone who just simply doesn't want to give up control?
Well, what's going to happen now, Sherry Redstone, she has decided that she's going to pursue the sale. It all balanced out with National Amusements. She's going to sell that alone. It'll be better for her to decide to sell Paramount by itself or to merge with another company without this National Amusements. So right now she's got 5 suitors that are interested. We know there's Sony, we know that there's Edgar Brofman. We also know that there's Apollo Global Management that has always been there. Apollo really wants this deal, and Apollo would have proposed a $26 billion deal, and that offer was a little bit more than what Skydance was willing to pay. But that deal proposes a couple of tough regulatory scrutiny issues here.
Okay.
Because they're a foreign entity.
Yes, yes. Kimberly, thank you so much. I'm sure there'll be more drama to come. I doubt this is over.
This should be a movie.
It should be a movie.
Edie Falco should play Sherry Redstone. I thought about this.
Kimberly, I see a future for you as a casting agent. Whenever you want to give this whole thing
Call
up.
me Hollywood.
Kimberly Adams, thank you so much on the soon-to-Hollywood drama of Sherry Redstone and Paramount. Okay, let's get to some breaking lines. The EU, we know that the G7 meeting is happening now. The EU is going to be imposing additional tariffs on EV imports from China. We had been expecting this, but we have finally gotten the news. Our reporting had suggested that it would be a 25% tariff. However, the current headline coming in now, they will be imposing a 17.4% tariff on BYD specifically. That is BYD EV imports from China. So this is additional EV imports coming from China. So again, our reporting said 25%. This one specifically on BYD is 17.4%. Let's get more on this story. Let's bring in Bloomberg's Rebecca Chung-Wilkins, who is in Hong Kong. So Rebecca, we're starting to get these headlines rolling in. We're starting to hear the actual figures that Europe is planning on doing when it comes to tariffs and EVs from China. 17.4%, a 20% tariff on Geely EV imports from China. Again, these numbers are all around 20%. They are slowly trickling in this morning. What difference does it make? How big of a blow is this to China, and do they need to respond? Will there be retaliation?
Well, just for context here, that standard baseline is around 10%. We were thinking or wondering if we could see something on the higher end, 25 to 30. So 20% might in itself be something that's a little bit, we're seen a little bit more modest, as more modest. But certainly any kind of tariff is going to be a blow to Beijing. The EV sector is one of the fundamental parts of how Beijing is remodeling its economy. It's one of the so-called new three drivers of growth that are in some ways intended to make up that shortfall from the property decline that we've seen really continue to hit and continue to hurt the Chinese economy for years now. So certainly is a blow. The EU is arguably the most important EV export market for China. There are ways that it can possibly get around. So we have seen, for example, this promise of a BYD factory in Hungary. We know there's another Chery factory going to be placed in Spain. And that is one way, for example, where Chinese companies can go into Europe, access the European Union directly, create jobs on the ground, help the local economy. We might see some sort of response in that sort of way as well. Remains to be seen, I think, if we see a tit for tat. Li Qiang, President Xi Jinping, the Chinese officials have made a big effort here trying to sell the European Union and individual European nations on this idea that they want to keep trade lines open. And the sort of punitive sort of retaliatory measures that we've seen so far have actually been relatively modest when it comes to the EU.
Okay, Rebecca, thank you very much. Bloomberg's Rebecca Chung-Wilkins. Just to recap the lines we've gotten from the EU, they will be imposing additional tariffs if you're just joining us now. The figures are this: 17.4% tariff on BYD, 20% tariff on Geely, and a 38.1% tariff on SAIC. They will also impose a 21% average duty on cooperating beverage producers in China. So this is also extending beyond just EVs. This is also looking at BEV producers in China. So BEV rather than beverage, BEV producers in China. So this is a wider EV target. And again, the numbers here are ranging from 17.4% to 38.1%. Let's get now to the earnings front. Oracle shares up some 8%, a little bit more than that this morning. Better than expected quarterly results and a partnership announcement with Microsoft and OpenAI. Let's get to our tech equities reporter. It's Subreth Patnaik, who joins us now. Here we have an Oracle, Subreth, that's partnering with some of its enemies, perhaps, some of its rivals, but it is this OpenAI partnership, we saw it with Apple yesterday, that gets the market excited. What does a partnership exactly look like?
So it's an interesting way of putting it. They're really getting close to some of their biggest rivals because to grow big tech businesses, big tech has been doing business with fellow big tech players like Amazon, Microsoft, and OpenAI is the newest kid on the block, and anybody kind of trying to do an alliance with OpenAI see the shares kind of spiking. So we have seen strong bookings, which is a very small business for Oracle, but investors are all eyes for anything AI right now, and the shares are set to open at a record high after the results yesterday.
And those partnerships, I mean, they obviously only cover a small part of Oracle's total sales, and even though that's what the market was excited about, what did the rest of their results look like? Because we have seen other cloud providers, other software providers start to struggle this earnings season.
Honestly, the rest of their business was pretty mixed. We didn't see a strong bottom line or top line, but investors are clearly very interested in this side of the business that they see as the future. And in terms of getting into AI, Oracle still seems like a very cheap bet with a PE of just about 19 times forward earnings compared to like an NVIDIA, which sits at like 40 times, or even the NASDAQ 100. So yeah, that's definitely what the investors were looking for, and they got that.
Okay, Subreth, thank you so much. That is Subreth Patnaik. Thank you so much for joining us on Oracle. Okay, coming up, we're going to get you ready for the busy Double Risk Wednesday that awaits you in about 3 hours' time. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. Manish is off for the rest of the week. All right, let's get you set up for the day today. I mean, you know what today brings, but first, President Biden is going to be heading to Italy later this morning for the G7 summit. That starts on Thursday. They've already condoned China's support of Russia. Then it's the two main events. The first one, 8:30 a.m., U.S. CPI, and then we have a Fed decision at 2 p.m., followed by Chair Powell's news conference. Mike McKee is down in Washington for us to help set up the busy day. Mike, just break it down. What are we expecting?
Well, we're expecting CPI to ease a little bit, but not a lot. The question is how much, and what does it take to impress the Fed? Fed officials have been saying they need a couple of months of progress. At this point, this would be 0.1% in the core, lower on a year-over-year basis, and maybe that is kind of what they want to see. But it's going to be all about maybe how far we go out on 3 digits in the CPI rate, because for some of these categories, it's only going to take a very small change to make it either go up or down. But watch rents. Rents and OER are going to be the big issue for the CPI. After that, we get the dot plot. The dot plot thickens. It'll take 6 people to change their dots to get down to 1. It would only take 1 person to get down to 2 dots. And the betting is on Wall Street, we get 2 dots, but no word on timing. That might come a little bit later when Jay Powell gets up and talks to the press. We'll see if he sounds dovish or hawkish, gives us any kind of time frame. But there's a lot for traders to watch today.
I mean, Mike, just quickly here, obviously they're likely to have had the CPI numbers to put that into their consideration. Armed with the strong jobs data on Friday, we're just talking to Citi, who said actually it's not as strong when you look at the unemployment rate. But how does the recent data we've gotten color this decision?
Well, it keeps the Fed wary and takes early moves off the table because they're going to want to see, as they say, more data. Earlier in the year, Jay Powell said maybe we can have a strong labor market and declining inflation. Obviously, the folks at Citi don't necessarily agree. So we'll have to see which one of them is right.
Okay, Mike, appreciate it. We'll let you go. Get some coffee, gear up for your busy day. Mike McKee in D.C. for us. Let's recap some of these headlines we're getting from the EU. If you are just joining us, the EU will be imposing additional tariffs on EV imports from China. Let's break down some of the numbers because they vary depending on who you are. 17.4% tariff if you are BYD. Geely gets a 20% tariff. SAIC will be getting the highest tariff, 38.1%. Overall, if you are a what they call cooperating battery EV producer in China, you will get a 21% average duty. For those who are non-cooperating, presumably this is SAIC, you get that 38.1% tariff. Now, Tesla may also be getting an individual China import duty rate under the EU tariffs. China basically imports all of its Model 3 sedans that it sells in Europe for China, for context here. So they're importing a lot from China to get Teslas in there, but they may be getting their individual import duty rate under the EU tariff. So again, these tariffs range from 17% to 38%, depending on whether or not the EU deems you cooperating or not. The big question for this will be, is it enough for Germany? There's still a huge overcapacity of EVs that BYD itself says that it wants to be the top seller in Europe. Is a 20% tariff enough to discourage folks from buying a very cheap Chinese EV? Germany will certainly hope it is so. Okay, we'll follow that. Plus, get ready for CPI less than 3 hours away, followed by Jerome Powell on the main stage.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Fed's not going to move Wednesday. The bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year?
Until we see a weakness in the economy or inflation really down to 2%, then they're just not going to cut.
If they're going to lean in one direction or the other, they're going to lean towards caution before cutting too quickly.
So they're going to try to do what they can to give an accurate picture of where they're headed. But the problem is that they're data dependent.
If you become too data dependent and don't take longer term views, you end up risking real mistakes.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide. Equity markets at all-time highs coming into Super Bowl Wednesday. Equity futures adding some weight to that rally. Futures this morning higher by 0.1%. Your lineup today looks a little something like this. At 8:30 Eastern Time, CPI. At 2 p.m., a Fed decision and forecast. 30 minutes after that, a news conference. One question this morning: how does this morning inform this afternoon?
And just to give a sense of how rare it is, the last time that we had a CPI print on the same day as an FOMC decision was June 10th, 2020. It has been 4 years since we have seen this type of potential doubleheader, and it does raise a question. Doesn't the Fed already have this data? How much have they already incorporated this, or are they going to be sort of rejiggering quickly all of their estimates as soon as we get this print?
Well, it's all about the estimates. It's all about the dot plot at 2 p.m. Where is that median dot for 2024? How many cuts do they imply for this year? This is what we're looking for based on our survey. 41% of economists expect the Fed to signal 2 cuts. An equal number expect forecasts to show 1 or none. And apparently the difference between 2 and 1, according to Steve Englander of Standard Chartered, is quite massive.
Well, and he's not alone. There's a question about whether they're just going to do no harm, and that's basically the overriding concept. They're not going to materially shake up the markets, but if they indicate just 1 rate cut, how much are they basically saying to the market, listen, we don't understand just how restrictive we are. We are rethinking some of our estimates, and we are pushing back significantly how much we plan on cutting rates. It will send a strong message. Do they want to send a strong message right now?
Let's start with the front end of the yield curve. The 2-year at the moment is at about 483. It is totally unchanged on the session. I just want to build on some work that Alan Ruskin at Deutsche Bank did for us the last time the Fed met. 4 consecutive meetings of the 2-year rallying on Fed decision day, and then we made it 5. So we've had 5 consecutive decisions where the 2-year has rallied. Basically, the conclusion is Chairman Powell has 1 gear. Does he show a different gear a little bit later?
So this is the odd thing about it. We just had the 27th record high on the S&P 500, the 15th record high on the NASDAQ. We've seen this rally in bonds. And if you hear all of the different projections from economists, they're all talking about weakness under the hood. They're talking about how we just haven't seen it. Just wait. And there's this caution kind of pervading all of these analyst notes that we've seen for months that have not borne out. Does Jay Powell lean into that at a time where there still is a sort of underlying angst about the revival of inflation? The answer is no, because there's no way he's going to suddenly come out and overhawk the expectations, because he has never done so before. Maybe this is going to be a new pain speech, but it doesn't seem like a lot of people see that as necessary.
I just wonder what the chances are of reopening the door to July a little bit later this morning. I know that's sort of a fringe argument, but we can have that sort of conversation a little bit later. We have got CPI later this morning at 8:30. You've got a chairman who's going to basically go into a news conference, who we know has done this before. There's some daylight between him and the committee sometimes based on what he delivers in the news conference, what we hear from the Federal Reserve minutes. And most economists on Wall Street, pretty much all of them, have thrown the towel in on July. Team September, Citi, Goldman, Morgan Stanley. Team November, JP Morgan, Santander. Team December, the likes of Bank of America and Deutsche Bank. You've got team no cuts at all. Apollo, SocGen. I just wonder how some of this changes later on this afternoon.
Especially if he says we're making good progress. We just need to see a couple more prints or one more print. Does that increase the odds? Just to put some numbers on that, right now the chance of a July rate cut is 8%. As implied by the Fed funds futures. It's a 50% chance by September, so that's still firmly on the table. But we're looking at less than 2 cuts being fully priced into the market at a time where everyone's expecting they will come out and reaffirm some of their guidance, maybe taking off just 1 cut from some of the previous expectations.
I know the start of May feels like a long, long time ago, but it's not. And you have to remember what we were doing going into that news conference. We were waiting, is he going to consider another interest rate hike? You know, what will he say about whether we're sufficiently restrictive? Straight out the bat, I think the first response to the first question in the news conference, he said, we are sufficiently restrictive. And that was basically the news conference over. We've played this game a few times before.
Looking for him to be a hawk, and he never really delivers.
Yeah.
But in this particular case, and I guess that's the sort of tension right now between a lot of estimates from economists talking about weakness under the hood, and then the record high after record high after record high in the equity markets, which is, there's a real case to be made for that weakness. If he leans into that, he'll have a lot of support from that. You talk about the cracks that we've been highlighting, whether it's in commercial real estate, whether it's in the lower income consumers. He can lean into that. How many people are really pounding the table to talk about a sudden surge in inflation? Those people have kind of gotten quieter. So he can cater to these people without making an error in the minds of a lot of people. And the likelihood is that's what he will do.
A few scenarios to consider throughout this morning. Looking forward to doing all of that with you. A lot of this will be dictated by what we hear at 8:30 Eastern Time when CPI drops. The scores going into it, adding just a little bit more weight on the S&P 500 going into that data by 0.1%. In the bond market, yields just about unchanged on a 10-year to almost down a basis point, 439.42. The euro firmer at 107.50. Coming up this hour, we'll catch up with Bob Dole of Crossmark ahead of CPI and the Fed decision. Bloomberg's Herman Chan on commercial real estate risks, and Steve Rasciuto of Mizuho looking ahead to a new dot plot. We begin with our top story, the S&P 500 reaching a fresh all-time high before today's CPI data and Fed decision. Bob Dole of Crossmark writing this: despite all-time highs for equity averages, with technical stretch, little fear baked in, and sentiment optimistic, we continue to expect volatility to pick up over the summer. Bob, I'm pleased to say, is with us now for more. Bob, great to catch up with you, sir. Walk me through what you're looking for at 8:30 this morning.
Obviously, I'm data dependent, like everybody. Look, I have no idea what that number is going to be. We've had a string now of on balance. I wish the number was a little bit lower. I suspect we'll get that again. Inflation has remained sticky, and I think we'll see more of that.
Bob, you think that there's a risk here, a real risk, based on the conversations we've had over the last few months, that inflation stabilizes above target? Do you get the sense from the chairman that he shares that view?
Yeah, I think he has to continue to work into that view. Look, absent a recession, the probability of getting to 2% inflation, in my view, is pretty close to zero. So somehow they have to back into the language that, we've done enough, inflation's come down, maybe it's not going to get down to 2. I don't know quite how they finesse that, but I think that's where they're headed.
There's this issue of whether we're actually going to see that recession that so many people have been predicting. It just has been delayed significantly. And whether in some ways you think that we need that recession in order to get inflation back down to 2%. Is that kind of what you're saying?
Yes, Lisa, I think we do need that recession to get it down. Of course, the Fed doesn't want a recession, and they do want 2% inflation. That's a tall order in my view, and they're going to have to compromise on one or the other. And I think what they'll compromise on is let's not worry about inflation down at 2. We don't want a recession.
So given that, how do you arrange your portfolio? I mean, basically, do you say long bonds are kind of really hairy here, given the fact that inflation is going to be what has to give, not necessarily growth?
Yeah, I think, look, the bond market itself, I think, has been vacillating, as you know, with that trading range that it's not sure either. I think we'll get more of that. In the meantime, the economy, more importantly, earnings keep delivering, and that's why stocks go from highs to highs, at least a few of them.
How much do you lean into that, though, given the fact that you did just say at least a few of them, and we're talking about NVIDIA and anyone who partners with OpenAI? By the way, who are they not partnering with? They're basically, they are what NVIDIA is to hardware. That is OpenAI to software. Bob, at what point do you just sort of follow their tracks and invest?
Well, I think you have to be there. NVIDIA, Apple, Microsoft, we own them, maybe a little less than our benchmarks, but nevertheless, we think you have to be there. This is a story, and while these stocks have been great, they're still not ridiculously priced compared to any comparison to the past. So you've got to be there. And as you pointed out, we're having a narrowing in the market. So the average stock is doing nowhere nearly as well as the broad averages.
Hey, Bob, yesterday was a pretty interesting session. We had Apple at all-time highs. Lisa, right to bring up tech, but also need to bring up the financials. Financials, bottom of the pile in yesterday's session. Citi was down something like 3.7%. JP Morgan down by more than 2.5%. What do you make of some of the concerns that we had in the financial sector just yesterday?
Yeah, great point to bring up. That weakness, to me, can be bought. Look, I think the financials are still pretty cheap. A lot of lending took place outside the banking system, and therefore their balance sheets are better than you might think at this point in the cycle. And yet, credit worries are creeping into the system because the economy is not uniformly moving higher. It's becoming more mixed. And that's a confusing period. You get the manufacturing side saying one thing, the service side saying the other thing. How do you square that? And I think that's part of what the investors are concerned with in selling off the financials.
We'll talk more about this a little bit later in the program, Bob, with an expert of ours. But there was a concern over at PIMCO that we're going to see more regional bank stress. There is a belief, I think, held by many that maybe last year's story is just last year's story. Do you think we've left that in the past?
I think it's inevitable we will have more issues, whether it's around commercial real estate or things related. Not all financials have perfect balance sheets. So yes, we like the financials, but we prefer the bigger money center banks. They tend to have less real estate, financial services, the Visas and MasterCards of the world.
How much are the big banks, though, exposed to some of the political risks that we've seen? In particular, say some of the big European banks have really sold off, given some of the concern over what some of the new elections could mean for policies in the region. How do you gauge that? How do you understand how to insulate yourself from that?
With great difficulty, Lisa. The only thing I think you can say is they're pretty cheap, so many of the risks probably are in there, but there's so much policy uncertainty. There's so many elections still to take place in this calendar year, and we don't know which way. Take the U.S., for example. There'll be a big difference in the financial outcome depending on who gets elected president, who's controlling the Senate and the House.
Bob Dole, across Mark. Bob, thank you, sir. We don't know which way to look, so let's start here. Let's look to Europe, and we'll talk about the prospect of a change in leadership over there. This from Emmanuel Macron this morning, the French president. It's absurd to think I will resign before 2027. Some concerns about that in yesterday's session. At one point, the French 10-year yield was up another 10 basis points. Finished the session basically flat off the back of the pushback that we've had from the French government. I want to reduce the deficit by growth. Lisa, that's what we're hearing from Macron this morning.
And basically, you're not really seeing much of a reaction in the bond market in response to that. So it's unclear just how much this is being receptive. That point that you made about reducing the deficit by growth is key here. He said he is open to Social Democrat and Republican right proposals. The issue here is the potential for a downgrade. And we heard that from other people. France was just downgraded by some of the credit rating agencies. How much do they face another undermining of some of their credit worthiness at a time where this has been sort of the discussion for a long time, right? Growing your way into your deficit, and it hasn't really worked out in the way that many people would like.
I don't want to hand power to the far right in 2027. The words of Emmanuel Macron, the French president, this morning in a news conference going into the G7. We'll catch up with Anne-Marie later on this hour. He is going to that G7, a weakened leader in a big way.
Most of the leaders who are going to the G7 are going to the G7 as weakened leaders. That's what I find fascinating. How many of them, what proportion of these leaders are really preparing to step down or potentially could get unmoored from their positions? It might be the last for a number of some of the key leaders. How does that color the discussion at a time where there's a more populist bent to what we see from a lot of the electorate in a lot of these regions?
The France-Germany spread, still near the wide of the year. The French 10-year, the yield, 3.22. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The UK's economic recovery has stalled in the run-up to their general election. GDP was flat in April compared to the previous month. Economists had, though, expected a 0.1% drop in output. It is a setback, though, for Prime Minister Rishi Sunak. He had been campaigning on evidence that the economy is turning the corner. Paramount Global shares down in the pre-market more than 2%. The drama continues. Chair Sherry Redstone has walked away from a deal to sell the media empire to David Ellison. Redstone rejected the latest proposal from Ellison's Skydance on Tuesday after lengthy negotiations. There are other bidders waiting in the wings, including Apollo Global Management, Seagram's heir Edgar Bronfman, and independent film producer Stephen Paul. Paramount is loaded with debt and is losing TV audiences. And helping the S&P rise to a record yesterday was Apple, shares soaring more than 7% to close at a new record high. The gains added $215 billion to the company's market cap, making it one of the biggest single-day value adds by any company in history. That record came after the company's annual Worldwide Developers Conference, where it showcased a number of features related to AI and, like everyone, an open AI partnership. And that's your brief, John.
Thank you. More from Danny in about 30 minutes' time. Odd session for Apple yesterday. In the morning, stock did absolutely nothing all morning.
Everybody was saying basically buy the rumor, sell the news, and then all of a sudden people thought, wait, emoji? My face? I'm in. 7% rally.
Record high. Totally ripped. Go figure. Up next on the program, property pain for regional banks.
The Fed probably looks at the CRE situation and says, look, this is something we can't really address directly because this is a secular change in the demand for commercial real estate after COVID.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today Today, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
TK back around the table a little bit later on this afternoon. Fed coverage kicking off at about 1:30 Eastern time. The decision at 2 p.m. The scores going into it. Equity futures on the S&P 500 look a little something like this. Positive by 1/10%. Yields just about unchanged. 439.81. Need to talk about the latest over in Europe. Macron, the French president, absurd to think I will resign before 2027. Bramo, the French bond market's not doing much in response to these headlines. French banks actually picking up in today's session.
Well, that's picking up in today's session after an 11% decline since Friday, at least on Societe Generale. You saw all of the banks across the board pretty much hammered in France in particular, but across Europe, and frankly, there was contagion in the U.S. There is a question if there is uncertainty on policy on some sort of national or international level. That is the worst thing for banks. Regardless of what those policies are, the uncertainty makes it very difficult to plan ahead.
That's Europe. We need to talk about the U.S. Under surveillance this morning, property pain for regional banks.
The Fed probably looks at the CRE situation and says, look, this is something we can't really address directly because this is a secular change in the demand for commercial real estate after COVID. I think what they're watching more broadly is, are we seeing the effects of high interest rates? From that perspective, they're probably justified in feeling that the policy rate itself is high.
So here's the latest. Commercial real estate in focus for all the wrong reasons as one New York landlord sells an office building at a roughly 67% discount. PIMCO now expecting more regional bank failures in the United States, with many institutions holding tough to sell CRE assets. Bloomberg's Herman Chan is with us around the table. Herman, good morning to you.
Good morning.
This story sort of never went away, but it's back on the table in a much bigger way now. What did you make of that note from PIMCO just yesterday?
Right. I think the industry is in a pretty solid footing, and despite some of the negativity in the headlines, there's a bit of divergence between perception and reality, in my view. The banks have very small exposure to office commercial real estate. It's about 2% of their loan book for the larger regionals that I cover. And the underwriting's been pretty solid, and we haven't seen a lot of losses come forth so far. That being said, there is a big maturity wall in 2024, about $200 billion of office commercial real estate is going to mature this year. So there will be potential bumps in the road.
Let's piece this together. We'll catch up with someone a little bit later this morning from Credit Sites, Winnie Caesar, who's going to tell us that this asset class is not a homogenous asset class. Right. It has its differences.
Exactly.
What is the difference between that building in Midtown West and everything else you cover?
Right. So the interesting thing is that office commercial real estate all gets lumped together, but the regional banks inherently are regional in nature. So they lend a lot to suburban office properties that are holding up a bit better than what you see in central business districts. So you have to go to the details a bit more to really understand what the exposures are.
We're talking about this in part because some people are looking for the cracks, the strain on the system as we head toward a potential Fed rate decision. This question of restrictiveness that doesn't seem to be affecting the equity market, but certainly should have an effect on some of the commercial real estate markets. And we've seen it, but it just hasn't been sort of codified or solidified by actually having sales.
Right.
There is a difference between saying that perception is different than reality and saying there are still a number of banks that have to either merge or will fail within the next year unless there is a change in the rate structure.
Right.
Is it fair to say that there are still failures, they're just not going to be systemic in the same kind of way?
I think there will potentially be problems down the road for some smaller regional banks, community banks that have overexposure to commercial real estate and also maybe haven't built up their reserves like some of the larger regionals. So the thing with the worries about commercial real estate, this has been going on for quarters on quarters now. So banks have been building up their reserves, cushioning their reserve and allowances in the event that losses do occur. So there are some smaller banks that have less a thinner cushion, so there could be some problems.
There's also this issue of a lack of forced sales. So just haven't been the volumes for price discovery. And if you start to get a couple of sales, well, all of a sudden you have to mark to market. Do you have a sense of who the rescue banks are at a time when we spoke to Bob Diamond, formerly of Barclays, saying it wouldn't be in anyone's interest for the JP Morgan to bail out another bank?
Right. So the next tier down of the large regional banks, PNC, for example, has been pretty vocal about looking for potential M&A down the road to be able to compete for the likes of JP Morgan and Bank of America. And they've done a really good job extending their reach coast to coast with a recent BBVA USA deal, but they want to get bigger. There's other banks like US Bank Corp that's also in the same boat. So we'd expect the larger regionals to really participate down the road.
You know, there's a generation of investors that are somewhat spooked by this conversation. They remember a phrase, and it sounded like this: subprime is contained. And when they hear people talk about commercial real estate, they hear it repeatedly on programs like this. CRE is contained. Again and again and again. Is there anything that makes you think you might be wrong? Is there anything at all that's sort of on your radar that you think is something to watch?
Really, if we get something other than office commercial real estate troubles, if it metastasizes to other areas like multi-apartment lending, for example, or if we get higher losses in areas like commercial lending, which we really haven't seen yet, that would create more worries, but the actual exposures to office seems to be fairly manageable.
Let's build on that. And actually, this is something that's kind of controversial. A lot of people saying that it isn't the high rates where they are right now that's going to cause valuations to come down. It's actually if rates get dropped, say a percentage point, and get volumes moving again, and all of a sudden you get price discovery in a market that's essentially been broken for a couple of years. That's when you start to see the price declines. How aware are people of that dynamic? Do you buy into it that possibly when the Fed starts to move, that's when it will catalyze some of these issues?
Yeah, I think it's a two sides of the coin, what you're talking about. While that price discovery would be potentially a problem, the other flip side is that your refinancing costs are lower as well. So there could be a push-pull dynamic there that we'll still wait to see.
Herman, this was great. It's good to catch up with you, sir. Thank you. Herman Chan there of Bloomberg. We'll catch up with Winnie Caesar of Credit Sites a little bit later this morning on this story. PIMCO pushing back. More regional bank stress still to come. And that building in Midtown West getting a lot of attention in the last couple of days.
Well, I mean, the incredible discount that it was in Midtown Manhattan, given the fact that it was sold for lower than the amount of the loan, about half the price or the value of the outstanding loan, shows how much pain there could still be in terms of losses having to be incurred by a number of banks. There is a distinction between systemic failure and individual bank failure. And that's what I think a lot of people are struggling with right now, because it seems like there is more trouble down the pike, and everybody agrees there are going to be banks that are not going to exist in their current forms. Question is, can it be systemic? And person after person says no, 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 no. So it's not going to rise to the level of necessarily the Fed's attention. On the flip side, in other words, they're not going to necessarily cover all of these losses when they come down the pike if they're not going to break the system.
You can say it's not systemic. It doesn't mean banks won't fail.
Correct.
And that's basically what we saw take place last spring. Are you ready to catch up with Anne-Marie and her vacation in Italy? Because we can do that next on the programme. Something a little bit more cheerful. AMH in Italy, as President Biden prepares for the G7. Anne-Marie has been away for, it feels like a lifetime. A couple of weeks now, right?
Enjoying the southern coast of Italy with all of her friends.
Told me she might not come back.
Yeah, well, you know, we can't.
I still don't understand why we're not there.
Why
are we here for the Fed decision? Is that why?
I think that the Fed should decide in Puglia.
So do I.
Yeah, I think that it would be beautiful.
You know, the ECB goes on tour sometimes.
Yeah,
a couple of times a year.
I think that the Fed should.
The Fed should do a global tour. As Tom would say, central banker to the world.
Yeah, you would tour with bears.
Just trying to, you know.
Yeah, in Jackson Hole.
that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Equity futures on the S&P 500 positive by 0.1%, just a little bit of a lift after another all-time high at the close just yesterday. On the Nasdaq, we're positive by 0.1% on the Russell. Slightly positive as well, and the bond market lots to talk about. In Europe, not just the US, we'll start in the US, the 2-year, 483.60. A stat I mentioned a little bit earlier in the program, worth repeating. Deutsche Bank's Alan Ruskin, the last time we went into the Fed meeting, said the 2-year has rallied for 4 consecutive Fed meetings. You can make it 5 after the May meeting. Will we make it 6 a little bit later today?
Most likely, and this is what people were sniffing out yesterday. You make fun of me. Everyone makes fun of me for the auction obsession. Yeah, I was watching.
It was strong.
1 p.m. auction yesterday. Look at that. You're watching too. The 10-year notes that were sold. It was strong. That was unusual. It was unusually strong going into the Fed meeting. That is indicative of kind of A, where they're going to tilt, and B, where people think the data is going to come in, that it's going to come in with softer inflation that's going to give the Fed a pass to potentially cut rates going forward and sort of claim victory in the same kind of way.
Just put a floor under bonds after a 3-day slide on a 10-year Treasury. Let's turn the page to Europe. Can we put a floor under French bonds? Because they've been falling. Yields have been rising. I think we can use the word surging. You know, at one point we're up like 20 basis points in 2 days, which is more than notable. At the moment we're back to about 321, 322 on a French 10-year, down a single basis point. What does this line buy you? It's absurd to think I'll resign. It's worth about a basis point this morning. That's from the French president, Emmanuel Macron.
Yeah, and you could argue that he wants to reduce the deficit by growth also is worth about a basis point in order to sort of relieve some of the concerns that people have that France is going to continue to expand its deficit and get downgraded once again by credit rating agencies. He's in a tough spot, and you raised a really interesting point earlier that I think we should sit on for a hot second, which is he's walking into the G7 incredibly weakened. People are definitely questioning how much power he has. How much is Meloni, almost the most powerful politician in the room, because she actually has the mandate that so many other politicians clearly don't have with their populace?
A big time, because at the moment it looks like there's not much daylight between her and where the electorate is going at the moment, particularly after those results over the weekend. I'd say something else about what's developed in France over the weekend and over the last couple of days in markets. Deficits matter. Don't be conditioned by your experience in the United States. America has had this privilege to behave recklessly for a long time, and we can talk about whether they'll retain that privilege for much longer. But deficits mattered in the UK. Deficits matter in France. They don't just matter in places like Italy and Greece. They matter elsewhere too.
Which, of course, if you fast forward, at what point do they matter in the United States, in the biggest, most liquid market for rates in the world? This has been on people's minds for quite a while. And honestly, this was the biggest debate at the PIMCO quarterly meeting or 3 to 5 year forecast meeting, where they basically were saying, we're sure that it will matter at some point. We just don't know when that point is, when you're going to get that incredible pushback. Could it be some policy shift, some election that triggers that? It kind of speaks to this point of political risk being something that you can't game out and you can't bet on, but it doesn't mean it's not there. And it doesn't mean it can't rear its head and cause a sudden market reaction without people expecting it.
The ghost of Liz Truss's government just working its way through global bond markets. I do like that. Okay, other surveillance this morning. A double dose for markets. The latest CPI data coming at 8:30 Eastern Time. Bloomberg survey expecting core CPI to come in at 0.3% month over month. Then the Fed decision at 2 p.m. plus Fed Chair Jay Powell news conference 30 minutes later. So setting the stage for the forecast is CPI this morning and setting the stage for the news conference the forecast we'll get at 2 p.m. How much does one influence the other?
Well, this is sort of the key, is that people are looking for a dovish Fed Chair Jay Powell. As you've been saying repeatedly, basically the market will probably rally for a sixth straight time after his news conference. The projections are going to matter quite a bit, and where people fall on some of the forward-looking projections. And this may be the key meeting, the pivot point where people start to talk about what the long-term neutral rate is. Do they start to hint, the Federal Reserve, start to hint that they are acknowledging that rates might not fall as much as they previously thought, that we're not going back to that 2.5% neutral rate that people previously understood? That will be a game changer. It'll basically be the Fed coming to the market rather than the market coming to the Fed.
It's another one of those days where we'll spend the whole day talking about the dot plot at the Federal Reserve. We've got the perfect guest for this a little bit later, by the way. The former St. Louis Fed President, Jim Bullard. For those of you that have followed the Fed for more than a minute, you'll remember that Jim Bullard was the guy that just put his dot at the bottom of the dot plot and just left it there for years. Just sort of sank in, just said, I'm not playing this game anymore.
Yeah, he doesn't like connect the dots, draw by the dots. He thinks it's all silly. He doesn't want to play. He is going to play with us, though, and I'm very excited that we're going to have him on, especially at a time where I know that someone in our world really is a Boiler Up fan.
Oh,
and
yes,
so,
of course,
you know,
Purdue,
I mean,
the Purdue
this
connection.
Is probably
yes.
part of the experience that we're going to be having is, you know, go Purdue.
Purdue, Indiana. I forgot all about that. So
Really?
that conversation, yeah,
Oh,
totally
come on.
forgot.
That was totally the reason why we booked him, clearly.
That's why he's on.
Obviously.
Does he know that? Might do now. 90 minutes away, that conversation. Hopefully it's still going to happen. Elsewhere, the Biden administration looking to further restrict China's access to chips used for artificial intelligence. Bloomberg reporting officials are looking to target a new type of chip design used to process AI. It is still unclear when officials will make a final decision. Had a decision potentially from the Europeans today that we'll talk about a little bit later. Just looks like Europe, the United States, still pushing back against China's advance.
The way that they're pushing back, though, is different. And I think that's important, and we're going to parse that through over the next weeks and months quite extensively. There's a question of an effective ban versus just making it a little more expensive, which is not really a ban, especially if the products are coming in that much more cheaply. There is this issue that the U.S. has, though, and this I would say with Biden, he's proposing things that don't take effect that quickly and that don't have material kind of consequences in the near term, like electric vehicles from China. There are none that are coming into the United States. So how do you come up with something that has real-world influence without, A, jacking up prices for consumers, and B, without destroying business for American companies? And that is an albatross a lot of countries are dealing with.
It's election year. There's more to come, that's for sure. Elsewhere, G7 leaders looking to announce new steps on frozen Russian assets. National Security Council spokesperson John Kirby telling reporters to expect new moves to help unlock the value of sovereign assets in order to help rebuild Ukraine. Anne-Marie is in Italy ahead of those meetings and joins us now. AMH, I'll save the questions on your vacation. Tell us what we can focus on in the next couple of days.
Well, this is going to be the main potential deliverable that the Biden administration wants to get over the finish line. When it comes to those immobilized, frozen assets right now, this is about $300 billion worth. And there's been discussions for about a year on how they can use the funds from these assets to help Ukraine, with Ukraine restructuring. And the issue is at the moment that they're still at the negotiating table. We've seen a draft communique, but what's missing is the plan for how they will use this money. So what the U.S. would like to do is basically have this liquidity. What do these profits mean right now, the future of those interests? Can they give, say, $50 billion worth to Ukraine? But the details, even if the political will is there amongst G7 leaders, and Admiral Kirby saying they're going to get there, even if the political will is there, the details are really complicated. What happens, say, in 6 months' time when the EU 27 nations have to renew those sanctions to make sure these assets are frozen, and some of them, say, a Viktor Orban, doesn't want to do that and throws a wrench in the process. So it's these difficult negotiations, and we cannot really just assume that the elections that happened over the weekend are not making these conversations much more complicated. Because as you guys were already discussing, Emmanuel Macron comes here a much weakened leader. You have Olaf Scholz coming here when he's dealing with a lot of right-wing politics at home. Some lawmakers in the Bundestag actually didn't even show up to Zelensky's speech on Tuesday. The issues European electorate are feeling have to do with immigration. You've talked about this on Monday, and also the economy. And it doesn't really match up to what leaders are going to be talking about in southern Italy, in Puglia.
Anne-Marie, let's go there. Let's talk about how that's actually shaping some of the conversations. Yes, you're talking about the Ukrainian aid and how to get them some of the money, unlock it from the Russian assets. Those negotiations have been going on for a long time. In the past few days, how has the discussion on the ground changed, focusing more on things like what you just mentioned, like immigration?
Well, the thing is that this is the one deliverable they want to be able to come to the table with, and that they can as a G7 act. But at home, their electorate wants more focus on internal problems, cost of living, immigration. When it comes to immigration, this is something Giorgia Meloni has been focused on. She's really the standout after the European parliamentary elections. She has a plan to maybe boost when it comes to energy and food in Africa. We're actually going to have Larry Fink and Siasia Nadella here talking about investment in middle and lower income countries, potentially in Africa. Some of this kind of investment to maybe keep more people willing to stay in the global south instead of looking to migrate to places like Europe and the United States. But usually the high-level deliverables are done and dusted at this point. The G7 leaders come and they sign on the dotted line. But the issue you have right now are negotiators are still at the table trying to hammer this down. And what happened over the weekend is just casting a little bit more difficulty. There's a little bit more reluctance on the part of some of these countries to sign up for, say, giving Ukraine another $50 billion of interest payments out of the future when they're not sure exactly how they're going to be made whole in the future.
Come on then, what are we missing? We got the short straw. How good is it in the south of Italy?
Puglia is the best. I'll just say that. It's one of the greatest coasts. You have two coasts on the heel of the boot of Italy, and I definitely did not draw the short straw for this trip. I'll say that.
I'm not jealous at all. AMH will catch up with you a little bit later. Anne-Marie, with the Adriatic coast behind her, having the time of her life for the next couple of days.
You know, I feel bad for her.
Do you really?
She's suffering. I mean, couldn't you see the suffering? It was just like pain in her face. Just seemed really unhappy, out of her element.
She's going into Bari Vecchia, getting some orecchietti yesterday, enjoying herself, bit of gelato.
Yeah, you know.
My goodness.
Geopolitics.
My goodness. Spent all my summers there as a kid. Oh. Why am I not there? Anyway, all right. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The EU has notified Chinese automakers of an additional round of tariffs on EV imports. The European Commission says that they will range from 17% for BYD to 38% for some other automakers. They're expected to go into effect next month after an already 10% tariff currently. The higher rates will also hit Western car makers like Tesla, who export their cars from China to Europe, though the Commission said that Tesla may get its own rate. China has already signaled that it's ready to retaliate, threatening measures across agriculture, aviation, and cars with large engines. Elsewhere in Europe, French President Emmanuel Macron is calling on moderates to regroup to defeat the far right after Marine Le Pen's party won big in the EU parliamentary election. Macron addressed voters this morning for the first time since he called for a snap election. He said it is, quote, absurd to think that he will resign before his term ends in 2027. Meanwhile, the French finance minister Bruno Le Maire says that if the far right wins, quote, a debt crisis is possible in France, a Liz Truss scenario is possible. Let's get you a check on Oracle shares this morning, up 8.5%. The software maker reported better than expected bookings and announced partnership deals with rivals. They did that after the close yesterday. Oracle revealed a new agreement to make its namesake database available on Google's cloud infrastructure. In another statement, Oracle also announced a partnership with Microsoft and OpenAI. The CEO said that she expects revenue growth to increase by double digits in the current fiscal year, ending May 2025, fueled by strong demand for AI workloads. And that's your brief, John.
Danny, thank you. We'll check in with Danny again in about 30 minutes' time. Up next on the program, delving into the dot plot.
We're probably going to end up with two cuts in the dot plot, but that risks are skewed toward that one cut. Most of the members want to keep optionality about being able to cut interest rates as early as September.
That conversation just around the corner. Just what is the difference between 1 and 2? From New York, that's next. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 positive here by 0.1%. Just a little bit of a lift going into the Fed decision later. And CPI this morning, 440.21 is where your 10-year is. Under surveillance this morning, delving into the dot plot.
We are probably going to end up with two cuts in the dot plot, but that risks are skewed toward that one cut, and there's going to be the distribution will be interesting because it will show almost an evenly split FOMC between 1 and 2 cuts this year. Most of the members, which I think includes Powell too, want to keep optionality about being able to cut interest rates as early as September.
So here's the latest. US CPI due out at 8:30 Eastern, serving as the last piece of economic data ahead of the Fed's 2 p.m. decision. Stephen Rasciuto of Mizuho saying this: the May payroll report and the solid rise in hourly earnings strongly suggest that the FOMC will trim the number of rate cuts expected this year from 3 to just 2. The third cut is not likely to be dropped, but will be added to cuts anticipated in 2025. Steve's with us around the table. Steve, good morning.
Good morning.
Wanted to give you some space on this story. I think it's important because we've all been obsessing over whether it's going to be 3 down to 2 or 1. Are you saying there's not much difference? Look out 25.
There really isn't, because the forward structure of rates is what's been helping the economy along. And the Fed has been promising rate cuts for a very long period of time and promising sequential rate cuts. So therefore, as long as they don't change that narrative, the forward structure of rates doesn't change much. If it's 3 this year versus 2 this year, but it's 4 next year as opposed to 3 next year, what's the real difference if we're going to get to the same place in 2026?
How do you think the labour market conversation is going to influence things on the FOMC today?
Well, I think it should. I think the continued strength in the employment numbers, I think, are important. I think the uptick in the unemployment rate that we've seen is also important to keep them wanting to cut rates. But it's nowhere near the level that suggests we've gotten back to normalcy into the labor market, and therefore it restricts them from going further in terms of policy at this juncture.
So let's take a look at Nicky Leaks. Nick Timiraos over at the Wall Street Journal came out yesterday with an article. It's always important to read him before what we get, since he tends to have a pretty inside view of what's going on. His view is their best course of action for the Fed is to do nothing, make no moves, basically do no harm, make no surprises. And they effectively are taking the summer off to evaluate how hiring, spending, and inflation are faring 1 year after they lifted rates to a 2-decade high. Will markets respond to effectively nothing?
I think the markets have already priced in good news. You look at the way the market behaved with the 10-year note auction yesterday versus the 3-year note auction. I think people have put those trades into the market already. Doesn't mean there wouldn't be a positive initial response to it, but is it sustainable from this level? That really becomes the problem. The markets are defining a very, very nice trading range. If you look at the 2-year note, for example, okay, at 5%, you love to buy it. At 4.70, you don't want to own it anymore. You're more willing to doubly buy at 5 than you are to doubly sell at 4.70 because the Fed keeps on promising rate cuts. So therefore, that dynamic, I still think, stays in the market. There's basically a buy-on-dip mentality created by the forward dots.
And part of this is really hinged on this idea that the market does believe that the neutral rate is a bit higher than where we are now, but not materially higher, and that essentially the Fed will cut rates substantially at some point, giving the extra fuel without having the recession that so many people thought was an inevitability.
Well, I think you're right. I think people do believe that it's higher, but not substantially higher. I think it is substantially higher. This is where I do differ a lot from other people on the street. I believe the neutral Fed funds rate at a nominal level is 4%, which means that maybe they're 125 to 150 basis points restrictive. But given the fact that the forward structure of rates takes so much out, are they really restrictive at all? And this is why the economy's been so resilient. That plus fiscal policy, which has continued to be accommodative. We're looking at a $2 trillion deficit this year versus 1.5, 1.6 last year. And we're looking at an economy that has incredibly healthy balance sheets. So it's no surprise to me that the economy is resilient and will continue to be above trend this year.
I feel sort of Neil Dutta on my shoulder, arguing in my ear, saying, are you kidding? There's a lot of weakness under the hood. And actually, the Fed will be making a mistake when they don't cut next month, because what you are seeing is weakness under the hood in the hiring market. Lower and middle income families are spending a lot less. You see them curtailing some of that. You're seeing cracks in the commercial real estate market. We've been talking about that extensively, pressuring some of the banks. How much credence do you give some of these arguments?
Well, considering the fact that we bought 15.9 million in automobile sales last month, I'll sit there and say I think all those arguments are completely wrong. They're trumped up. They're made to look like that. It's easy to identify something negative, but it's not as easy to identify something positive. When you look at the claims data are telling you nothing's going on in the labor market. The continuing claims data are telling you nothing's going on in the labor market. The payroll data is telling you the economy is very, very healthy. Wage gains are telling you the economy is very healthy. You got an inflation rate here that arguably year over year is either 3.5 or 3.6 after the Fed has had the curve inverted for how long in here? I mean, the reality is this economy has underlying strength. I can identify something and say, oh, gee, that's horrible. The problem is that liquidity disappearing from the system, or is it finding someplace else to go? And the answer is right now it's finding someplace else to go, and that's what's keeping the economy resilient.
I've got visions of Neil Kashkari going into this meeting now, just pointing at that Bill Dudley opinion column from a week or so ago, saying sufficiently restrictive. What are you guys all talking about? What would change their mind?
Only time. You have to remember, this is a group of political economists. Because they're political economists, they really want to manipulate policy levers, okay?
What does that mean, they're a group of political economists?
They're not anti-inflation hawks, okay? Their concepts are how do we maximize social welfare by keeping a labor market tight, not how do we maximize social welfare by creating a consistent economy with 2% inflation. Okay, and allow the animal spirits in the economy to take over. They want to get in. They want to monkey around. They want to be the garage mechanic who goes in and says, "Oh, let me just tune up my little gas mixture on my carburetor to see if I get that little extra horsepower." That's the kind of people they are. They want to play with the levers. They've spent their whole lives itching to play with the levers. Now they're in the position to do it, and that's what they want to do. And unfortunately, we've seen when that happens in the past, we create an inflation problem.
Well, this is where I want to go. And actually, you pointed to this about the fact that the 10-year auction was successful. It was strong. And there's sort of a complacency. We've been talking this morning about, as John aptly said, the ghost of Liz Truss kind of circling around a lot of different economies and nations. How much is this sort of raising the specter of a sooner sort of, I don't want to say it, but, a sort of realization in the bond market? I'll just characterize it, a Liz Truss moment, as a realization in the bond market to really look at the deficit and the financing of it, as well as potential inflation going forward.
You know, when you go back and look at what happened to George Senior Bush, he did what he needed to do in order to bring the budget to a better balance after the Ronald Reagan environment, okay? And at that point, we were looking at 4% real yields at the long end of the curve. Market paid no attention to what he did. Bill Clinton comes in and raises taxes, and suddenly real yields drop at the long end of the curve, and the Bill Clinton miracle starts moving forward. This time through, I think it's just the opposite. When we get past the election and we see that we've got a $2 trillion deficit and whoever gets in wants to make it 3, I think that's when you can have that type of realization moment, which means over the balance of this year, the market continues to buy on dip.
You think we've got an inflation problem going into that as well later this year?
I think we've got inflation that's stuck at 3%, yes. And I worry that the combination of inflation being stuck at 3, not priced into the market, and the 2% real yields that's priced into the market when it should be closer to 3 are going to be a realization that unfortunately hits the market. But we probably wait until 2025 and we see that these people are really just willing to spend money ad nauseum. And that's when the bond market goes, hey, wait a second, I got a problem.
We've got a couple of minutes left with you. What is the difference between 3% and 2%? And don't just say 100 basis points. What is the difference? How big a gap is that?
There is not a big enough gap from a macroeconomic perspective. The question is credibility, okay? The world is sitting here saying every central bank is credible on 2% inflation. So therefore, we've traded currencies on nominal interest rate differentials, okay? But if the Federal Reserve is the lone central bank out there saying 3, but I have to prove my 3, that I'm really credible at 3, well, then do we start trading currencies on real interest rate differentials? And if we do, does the dollar go lower? If the dollar goes lower, then the inflation stories you've been having over and over again about the improvement that's taken place in goods prices holding down inflation reverses on the Fed. Then they have a real inflation problem.
What's the difference between saying that they're going to allow inflation to move within a target of 2 to 3% versus, say, just upgrading their inflation forecasts for the next year and the next year after that and the next year after that, but saying that we still have a mandate to get things down to 2%?
Really not much if you believe they're credible. The credibility becomes the issue. And this is where way you get credibility is when there is rampant fiscal policy excess. You create monetary policy restrictiveness to offset it. This is how you got inflation fighting credibility. When you're in an environment of when wanting to support the fiscal policy excess with monetary policy, you lose your inflation fighting credibility. And unfortunately, that's where I think they're going to go in 2025.
Steve, this was super valuable to get your opinion on the program. Thank you, sir.
Cheers.
Appreciate your time. Steve Asciuga there of Mizuho, looking ahead to the decision a little bit later, and an interesting 12 months ahead. The ghost of Liz Truss's government, not Liz Truss. Liz Truss is very much still with us. Liz Truss's government making its way around global bond markets.
Did someone message you on that?
No,
saying,
I just wanted to
Liz Truss is still
clarify.
alive.
I just
Don't
wanted
say
to
that she's a
clarify.
ghost.
I personally
That's
just wanted to clarify.
The Liz Truss moment, the ghost of the Liz Truss moment, kind
precisely.
of hovering over things. No, but it's
better.
true. And actually, what Steve is talking about is a really important thing, which is basically how do you maintain credibility while not achieving the target for years and years and years.
Sort of tacit, isn't it?
Yeah.
Yeah. I mean, coming up next, second hour of Bloomberg Surveillance with a lot to talk about. Savita Subramaniam of Bank of America, Bloomberg's Michael Shepard, Winnie Caesar of Credit Suisse, Scott Cronin of Citi. A lot to cover. 8:30 Eastern, CPI drops.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.